Good morning, everyone. I'm Brad Smith alongside Brian Sozzi. This is Yahoo Finance Live. Let's get right to the three things you know to start off your morning. First thing you need to know, a wave of bank results are giving us a read on financial conditions after March's downfalls of Silicon Valley Bank and Signature Bank. JPMorgan and Wells Fargo coming out of the gates strong thanks to higher interest rates. JPM smashing profit estimates in the quarter and raising its fiscal year net interest income outlook to $81 billion. On the downside, it warns of a tightening financial condition environment as well. Investors are closely analyzing balance sheet health and alongside slowing growth in loans as well. JPMorgan and Wells Fargo, they put aside a combined $2.3 billion for souring loans. Second thing you need to know, U.S. retail sales came in worse than expected in March, dropping 1% as consumers pull back on spending. Investors were closely watching this data to see if it further points to a slower U.S. economy and to check in on how the consumer is holding up. Now, this data contrasts with what the big banks told us this morning, that the outlook for the U.S. consumer is healthy. The third thing you need to know, Boeing shares are tumbling this morning as the plane manufacturer halts deliveries for some of its 737 MAX jets due to a supplier quality issue. Boeing said its supplier Spirit's Aerosystems incorrectly installed parts of the plane. Now, the company warned there will be major impacts on near-term deliveries of its three of its major jets and one of its military planes. This is the latest hit for Boeing and another hurdle for the 737 MAX. And it also comes after it had to temporarily suspend 787 and 767 deliveries because of regulatory issues.
Bank earnings season is upon us, giving us a look at financial conditions following the collapse of Silicon Valley Bank. JPMorgan kicked it off with a big beat in the first quarter and raised its fiscal year net interest income outlook to $81 billion. And Brad, I was seeing all these bank stocks up across the board, and the vibe is like, well, maybe March didn't even happen. Maybe there was no big bank turmoil because a lot of these banks, JPMorgan including, calling out strength in card services, strength in certain parts of their trading businesses. Now, we did get a little bit of a warning from Jamie Dimon. He loves his weather references, saying that you need to be mindful of storm clouds on the horizon, but by and large, the market is liking these results from JPMorgan and many other banks, and they were pretty good. And I would say somewhat surprising to see a JPMorgan, always a little bit conservative, come out here and raise an outlook for net profits after a month of banking turmoil. Absolutely shocking.
Yeah, he is quite the economic meteorologist when it comes down to it. And of course, in the financial conditions that we're assessing with all of these major banks, you have to look to a few things here. And even as he was talking about what they're monitoring for potentially higher inflation for longer and thus interest rates, the inflationary impact of continued fiscal stimulus and the unprecedented quantitative tightening and geopolitical tensions, including relations with China and the unpredictable war in Ukraine. All of those matters considered, you have to look across where they did see some of the most massive growth in this most recent quarter and where going forward from here, they're going to expect some tailwinds to be able to ride at least in this kind of storm cloud scenario that they've continued to monitor from JPMorgan's side. And particularly, you could probably look no further in terms of the biggest growth category for the company that they saw in this most recent quarter. On net income, consumer and community banking rose by 80% year over year. Why do I bring this up? We think about all of the regional bank turmoil that had taken place and ensued in the tail end or midpoint of March, and what that meant for the quarter as it came to some of the confidence in the broader banking system. And that's where you're going to hear a lot of commentary from all of the major execs. And it already has started to roll in and trickle out over the course of this bank earnings season, but how they're going to try to reassure and confidence in that banking system as well. And particularly here, even as we're looking through that revenue line item for consumer and community bank, bringing in $16.5 billion. That was up 35% year over year. And so if there's anything that you can kind of extrapolate from that, it's that the big banks, in times of turmoil for some of the regional banks, they tend to see even more of those fund flows, even more of those assets head their way. And of course, it continues to come back to this question of too big to fail or not, but still there needs to be some type of concerted effort. And JPMorgan was one of those when it came to First Republic Bank as well, which I know we'll talk about a little bit more later on the show.
The strong get stronger, but investors have a really, I think, this is a challenging one to interpret. Do you reward a JPMorgan, and we'll talk about Wells Fargo in a second, and a Citigroup for the quarters they just had, which were surprisingly strong, Brad, or do you lock in on what Jamie Dimon said about likely tightening financial conditions.
Right.
Because when you hear something like that from a major bank, a leadership bank that has one of these fortress balance sheets like Diamond talks about, you have to wonder, what is the outlook for economic growth? What is the outlook for the consumer? Retail sales under pressure this morning. We'll have more on that later. But when you see that call out of tightening financial conditions, it's a little bit worrying, and you have to wonder what these banks saw in the first quarter. Is it as good as it's going to get this year?
Here's one interesting thing to do a hotkey on for all of these earnings reports that come throughout the bank portion of this earnings season. Just Control F or Command F, depending upon what kind of device you're on. Deposits. Deposits were down, actually, within some of the firm-wide metrics that they provided. They were down by about 8%. That was something that was also mirrored when you look through Citi's results as well. Deposits, even within Wells Fargo, and I know we're going to break them down in a moment too, deposits are going to be key to look at with relation to where confidence actually did play into some of the results or the lack thereof in that confidence, play into some of the results as a result of what took place with the banking crisis and turmoil that ensued at the tail end of the quarter as well. And so deposits, one of the direct corollaries that some investors can probably get some type of insight into how it even affected the big banks that are starting to report.
Let's pivot here, Brad, to Wells Fargo here. A decent quarter from Wells Fargo. I do want to call out, they had weakness again in their home business, again weakness in their auto business as a result of higher interest rates impacting that company, as many other companies have called out too as well. These bigger ticket purchases under pressure. Wells Fargo saw that as well. Did have some also weakness in investment banking. That investment banking more broadly in the financial services industry continues. Deal making has ground to a halt. Not that bad of a quarter overall for Wells Fargo by and large. Now, I did get a chance to catch up with Wells Fargo CFO Mike Santomasso on there was a media call, Brad, earlier this morning. I asked him if he's seeing tightening financial conditions. He hinted that might happen, just like Diamond called out. We could see his statement on that screen to Yahoo Finance earlier on. But by and large, consumers continue to spend pretty briskly. Now, I also asked him in the same breath, I asked him to do one of those analyst tricks, lump two questions in one breath.
Sure.
I still got it. I'm still pretty good at doing that stuff. I'm like, are you a buyer potentially of regional banks? Do you see yourself as strong enough? He declined to comment, but you have to try, Brad, once you get these people on the phone.
Yeah, anytime you get a little bit of their ear, of course, it's great to just lob those questions in.
I didn't ask him what he had for breakfast, though.
Well,
Yeah.
It's always interesting to know what they're having on a big day like this.
Probably nothing.
Maybe not really. Maybe nothing, exactly. But they did say, looking ahead, they're continuing to move forward on some of the risk and control agenda. That's their top priority. They're kind of pinning that as, and also mentioning that they're looking to develop some improved product and services to serve the customers right now in communities. But it's also going to come down to where for each of these banks they're continuing to assume risk, whether that be in the loans that they take on, whether that be in some of the bonds that they hold on to as well. And that's something that has continued to come up in our conversations with everybody who's monitored some of even as we were speaking with Gary Cohn earlier this week, one of the noted kind of heads of a bank previously who had to weather Goldman through the last kind of great financial recession as well, and was at the bank during that time, and just kind of spelling out what was taking place there. And then just a quick hotkey on deposits. That was down year over year as well.
Yeah, I do want to real quickly just again go back to that auto call out. Auto sales down about 12%. We heard from earlier this week when CarMax reported too, really just a bad quarter in all things autos. And as you start to think about the rest of earnings season, start to put some of these pieces together. Wells Fargo, weakness in autos. CarMax, weakness in autos. What does it mean for Ford? What does it mean for General Motors? What does it mean to an AutoNation? That's how you should be thinking about using a lot of these bank earnings.
Yeah, absolutely. All right, as we continue to digest these bank earnings, let's get a sense of how you should play your portfolio when it comes to the financial sector. We've got David Ellison, Hennessy Large Cap Financial Fund Portfolio Manager here. David, just want to get your high-level takeaway from what we're seeing so far as the banks report.
Well, you guys have done a pretty good job of listening to your commentary, pretty good job of sort of laying out the issues. I think so far, I think the bigger banks are telling us that the conditions are okay, not great in the economy, and that's good enough for them. I think they're managing through, a massive change in rates and the yield curve. They're dealing with, changes in credit conditions, and so I think they're managing through pretty well. It doesn't necessarily mean the stocks are going to double or triple, but I think if you look at the big banks, which is the bulk of the lending activity in the economy. They're strong. They're ready to continue to participate in the economy, and I think they'll be fine. I think you're going to hear less sort of enthusiastic numbers as we talk about the smaller banks, because they've been more impacted by obviously what's happened the last month or so, and been more impacted by the rate activity of the last 2 years. So we'll see what happens. But so far, at least we have a few stocks that are up. As you know, it's been a very difficult 2 or 3 weeks here.
David, what happened with these results? I think just because of how chaotic March was for the financial services industry, you have a JPMorgan out here smashing estimates, Wells Fargo doing pretty well. In the case of JPMorgan, calling out the potential for higher net interest income as the year goes along. What did investors miss? Were the first 2 months of the quarter just that darn good?
Well, I think that, I think the issue is that, rates have moved up, and obviously the big impact in the rise in rates really wasn't felt to the last month of the quarter. But I do think the street is underestimating the bank's ability to raise the yield on assets and offset the rise in the cost of funds. And I think if rates were to stay here, I think you're going to see continued expansion of the margins, because those loan yields are going to continue to move up. So I think they were too bearish on margins. Credit's about what it's expected to be. It's not going to be, great. It'll be okay, but it's not going to be like it was the last 2 years. So I think that, the banks actually are going to work and doing their jobs. As I say, that you want to own companies where they're working harder than you are. And I think that's where the banks are now. They're working very hard to manage through the yield curve, the credit, expense issues, fintech, risk, competition, regulatory stuff that's coming down the pike, whatever. So they're working really hard, and so far it appears to be working.
David, perhaps you can help us kind of compare and contrast some of the economic data that we're seeing come through with what bank CEOs are telling us, which is that the consumer spending is remaining healthy. However, you do have credit card sales that are up. You also have card loans that are up. You have retail sales data on the economic side that came in below expectations there. And so with that in mind, I'm not saying somebody's lying, but it's possible for a person to be healthy but still have a cold that they can navigate through, or have severe allergies or some type of sinus infection. I mean, at the end of the day, it's kind of how the banks are classifying this, no? And if so, is it possible that consumers, they might have a cold right now?
Well, I think and that's a great question, and I'm going to answer it, and I'll probably be wrong with my answer. But I think when you were saying it, I was saying, look, the issue is unemployment. Unemployment is very low, and if I lose my job, there's somebody that's going to get a job and take over my car loan or my house loan, so I think that's one of it too. I think because of what's happened, let's say even since 2008, the banks just don't take the risks they used to take. And so you're not going to see, in my opinion, big credit problems at the banks. You're going to see it at private equity and private, debt funds and, non-bank banks, and the shadow banking system is where the credit issues are going to be. The banks just do not take the risks they used to take, and it's showing up in the credit metrics that we're seeing today.
David, real quick before we let you go, is Citi here an undervalued turnaround story?
Well, it's been that way for 10 years. I own a little bit of it because the day I finish selling it, it's going to double because I'll make the bottom in it. So, I just don't think we know what Citicorp is. And management's making good money, not doing much of anything. The directors don't hold them accountable. It is a European-style bank that really is not doing much of anything, has no identity, doesn't really have any leadership, and they should. And you see that with the other 4 big banks, the other 3 of the 4 big banks that are protected out there. They just need to, get somebody who actually tells the story. And they don't have that now. And until they have that, I think it's dead money.
All right, we'll leave it there. David Ellison, Hennessy Large Cap Financial Fund. Always good to see you. Have a good weekend.
Yeah.
Out this morning, U.S. retail sales decreasing by 1% in March, double the estimated decline by economists. Sales declined for a second straight month, indicating household spending is cooling with high inflation and rising borrowing costs weighing down U.S. shoppers. Big declines were seen in the appliance and general merchandise categories, aka those interest rate sensitive businesses that you often put on charge cards. This comes on the heels of softer than expected inflation data in the CPI and PPI indexes, suggesting disinflation trends are starting to take hold. Plus, we've got consumer confidence data out later this morning for more insight into how shoppers are feeling. We'll be breaking down what all this economic data means to your portfolio coming up. Meanwhile, Boeing is getting hit in the pre-market trading after the plane maker paused deliveries of its 737 MAX jet thanks to parts problems. This has been another challenging year for the folks over at Boeing. The plane maker saw deliveries decline in February, hampered by supply chain issues and a Dreamliner delivery pause. How will this latest roadblock impact the plane maker's profits? We'll have more for you coming up. It's time to go inside our morning brief newsletter, though. Earlier this week, I got the chance to sit down with the Carlyle Group co-founder David Rubenstein for a wide-ranging interview discussing the current state of private equity, the overall stock market, the economy, and even his new television series. But here's what he had to say about the banking crisis and what might be done to fix it.
I think First Republic Bank is clearly on a watch list, and probably somebody at some point will buy it. But the challenge there is it needs government assistance. There's a big hole in the balance sheet of First Republic Bank, I've been told, and therefore I suspect the government will have to provide some assistance if that deal is going to get done.
Brad, when you hear probably one of the most plugged in high financiers and David Rubenstein tell you there might be a hole in First Republic's financial statements, that's a major red flag and something maybe not reflected or appreciated in the positive reactions to these bank earnings results.
Yeah, it's a huge red flag. I mean, of course, we all remember the number of banks that had to come to First Republic's rescue just a few weeks ago. And I think it really showcased how much confidence that those other banks wanted to reinstill within the broader system, of course. And we still saw some kind of net effects show up in the deposit numbers as we've been breaking down for all of the banks one way or another. And so I think going forward from here, even as we think about where and what steps regulatory-wise that need to come about, because let's remember, it was kind of an unprecedented scenario that we had seen between the FDIC, Treasury, the Federal Reserve have to all act at once. The president basically on a Sunday needing to say something about the situation. I was in Austin, Texas while it was taking place, and venture capitalists were talking about what this would actually mean if nothing happened by Monday. And so there's still some of the kind of systemic unanswered questions, but the ramifications have been talked about in everything from the earnings that have started to flow through from the big banks, as well as in the annual shareholder letter from JPMorgan Chase CEO Jamie Dimon.
And let's be clear, there is zero appetite for the government, or I think for taxpayers to see a government bailout of a First Republic Bank.
Well, no.
Zero, like none, like zero appetite.
Well, I think there's zero appetite to see a bailout of banks again from the general public as well.
Indeed. All right, you can catch the full interview throughout the day here on the Yahoo Finance homepage, our app, and over on YouTube. All right, joining us here in studio for all things banks and portfolio planning, we welcome in David Hardin, CIO of Summit Global Investments and portfolio manager of the SGI Dynamic Tactical ETF. Good to see you here. Really some positive reactions to these bank earnings. Your take on the results, and is the market right?
Well, I think the results are very good and welcomed from the market. The fact is that volatility continues long after things actually get hit. So I do expect some more volatility in the future. But these banks are down tremendously, especially the regionals. And so having some positive earnings by the big boys, if you will, that's a really good thing. I think it really helps the market gain some confidence. And right now, let's face it, everybody's future look ahead is pretty cloudy, and there's a lot of uncertainty. And so because of that, I think this is a very good sign for the market to probably grind higher over the next while.
What type of scrutiny do you expect there to be from the investor community or even analysts who are peppering these CEOs and the executives with questions about their own holdings, what they're holding on their balance sheet, whether that be in the form of bonds or even the amount of loans that they have to continue to kind of raise the profile of the loan, the net interest loan margin, or the loan kind of allowances as well that they're holding on to? That's
a good question, Brad. I think that when I look at it, I think we learn from our past mistakes, and letting that be, I think that we're going to demand more transparency. Mm-hmm. We want to know what the risks are. We want to be able to price those risks in those stocks, and we want to be able to choose which ones we like. So Right now, or in the past, we weren't able to see that. It would come out late. We'd find out in the week and say, hey, oh my, we have to get out of this company or what have you. So I think because of the banking crisis that happened in the end of the quarter, I think you're going to see a lot more pressure to be a lot more transparent. And let's face it, the Congress has to do more in a sense. They always have to feel like they need to do more. And I think you're going to see some more legislation come out around showing us more of the risks involved. So they have to, and I think they will.
Is the banking crisis over?
No.
And what does it look like moving forward? Is it more blow-ups like we saw in March, or is this some form of rolling crisis?
I think it's more rolling, but if you go back to the great financial crisis that we had back in 2008 and 9, the reality is that some of the other blow-ups came months later, right? So Bear Stearns went under about spring. We didn't have the rest of the blow-ups till the fall. So I do think this is more maybe the carry in the coal mine here that's saying, hey, there's problems in the system. We need to take a look at this. This is what this transparency that we're talking about. We want to have more transparency and identify them now. The good thing here for investors, even though there's a lot of bearish sentiment out there, the good thing is that we have learned a lot. Our management's better in these companies. They're helping each other out. An amazing consortium of different individuals to come to the rescue, if you will. And thank heavens they did, because if they didn't, we'd be in a much worse situation than we are today. So I think we've learned from the past. I do think there's some, good things on the horizon, but we're not through it.
So what is the word then to consumers who are applying for a home loan, who are looking to get a loan for a vehicle even, and are trying to go to the banks at a time where there is going to be a tightening of how much capital they're willing to put on the table for loans or any type of allowances for that relationship with consumers at the end of the day?
I think there's a problem going to arise there. Just like inflation, we know kind of comes into the economy about 6 to 8 months after an interest rate hike. This is going to reverberate into the economy. And you're going to see some people not get the loans that they want or have to pay more. And that really impacts consumer spending, which has been one of the bright spots of kind of coming through the pandemic and coming out as we've had this consumer spending. If that rolls over, man, we're going to have some hard times. And that's what everybody's worried about, is that big R, that recession. And the reality is there's a lot of pressure right now on the consumer to continue to spend, and that will really impact them.
Well, then having said that, do you buy these stocks? Do you buy bank stocks off of results like this, given what might be coming in a few months?
I think you have to look for high quality bank stocks. I'm not afraid of bank stocks, but I think that you got to be careful, because one of the trends that we're having right now is that the babies are getting thrown out with the bathwater, and that means the ETFs are selling discriminately across all of the banks. So having something like the earnings today are good. Hopefully that settles those ETFs so that money can come back in. But if you're going to hold banks, you need to hold things that I think, like the ones that are coming out today, JPMorgan and others. I think that you have to hold quality earnings and really strong transparency. That's what I would look for in banks.
What if you say banks too volatile for my portfolio right now? Don't want to hold them, not interested in the way down or on the way up.
Yep.
Where else can you be looking?
Well, I think you need to go to some other areas. For example, we know that interest rates are coming to a peak here, in the sense that the Fed is probably not going to raise rates like they did in the last year.
Not as aggressively.
Yeah. And so where's that's going to land? It's going to probably lend to more technology. We've had the Magnificent Seven, if you will, in tech do really, really well. I think that spreads to the rest of the sector, and those probably cool off a little bit. And so if you're looking for another place that has less volatility, I think that the tech might have some less volatility. And let's face it, they've kind of prepared for the recession really well compared to how they've done in the past. We had layoffs starting in the fourth quarter. And so they've started to prepare for this a lot sooner, and they might do a lot better than what people are expecting into the kind of the tough times ahead. So short-term investing, I think you're right. I think volatility continues. We've lowered our exposure into banks as well. So I think that you have to be very picky in that space.
You know, we've heard FANG, we've heard FANG Mant, we've heard several different iterations of that. I don't believe I've heard the Magnificent Seven yet. I thought we were going to get towards Terramana at some point. Shout out to The Rock there, exactly.
There we go.
We were going to need that by this weekend. Thanks so much for joining us here, David Harden, who is the CIO of Summit Global Investments and Portfolio Manager of SGI Dynamic Tactical ETF.
Thanks for having me, Brad.
Absolutely. And coming up, shares of Express, they're surging on the back of its deal to buy bonobos from Walmart. We're going to discuss that, plus have the opening bell on Wall Street next. PNC Financial Services and BlackRock, they both are out with a beat on earnings in their latest quarter. Color me surprised. I don't know why. PNC saw a 19% rise in revenue compared to the same period last year. Hey, that's my bank. While BlackRock saw its net income slide 19% from a year ago. Just to remove myself from any bias, I'll start with BlackRock because PNC is a great Pennsylvania bank.
Nice.
Anyway, at the end of the day, BlackRock, 5% decline in assets under management. Revenue, that was down 10%. Net income, as we aforementioned, down 19% year over year. And still more of the commentary around the crisis of confidence that you had flagged earlier today, Saz.
Yeah, the other undercurrent of this earnings season, just from the bank perspective, is all of these CEOs coming out here saying, our bank is great. We have a great balance sheet and we're doing okay. We were here to help the taxpayers and the financial system because we had so much money and we were a friend. So that's the other undercurrent here. I suspect you'll see that story somewhere over the coming days and how the bank CEO, big bank CEO, was a friend to the entire world in the month of March. So there's that. But anytime you do hear a Larry Fink calling out and he's the CEO of BlackRock, calling out a crisis of confidence, that I think aligns well with what we heard from Jamie Dimon at JPMorgan about storm clouds brewing. And I understand the market's enthusiasm with these quarters, but that does not mean that April, May, June, aka the second quarter, is going to be just as fine and dandy as the first quarter was.
Yeah, and we're getting some kind of creative type of comparisons as well. Even the comparisons, and as I was talking about deposits earlier on, which is something to continue to keep an eye on throughout the bank earnings season, they have a comparison of the prior quarter. So if there's anything that you can kind of glean some insight into as average deposits, they only increased by about 0.3%. It's how can you compare that to the previous year as well here? And so that is something that I'm continuing to dive into here in the average deposits. And ultimately that did decrease year over year in the average deposits that they saw in billions come through for PNC. So that's something to also compare back to as well this time last year.
And PNC, another bank with rising charge-offs.
All right.
Now we have that opening bell on Wall Street as the big bank earnings season kicks off. We see the marvelous Miss Maisel.
Oh, with more enthusiastic. Come on.
It's bank earnings season, Brett. I get it, but I'm more worried about JPMorgan and Jamie Dimon and the storm clouds and potential expense cuts. It's just, I don't know.
It's all marvelous.
It's just how I'm.
You ask the CEOs?
It's just how I'm wired, Brad. Well, look, we had a lot to take in this morning here. We had the big bank earnings. We had a really bad retail sales report. We'll talk about that a little bit later, but that was a really ugly retail sales report. We had, I would say, some more hawkish commentary out of the Fed's wallet. We have that story now on the Yahoo Finance homepage. Lots for markets to digest.
Yeah, there is. And so I'm giving our viewers a look at the past 4 days just to kind of get a gauge of how we were trending coming into this. And ultimately, with some of today's activity, we're about as flat as it gets, just barely to the downside right now for the Dow Jones Industrial Average, only about 25 points in a move there. So we'll continue to watch that. But over the past 4 days, still net higher by about 1.2%. For the Nasdaq Composite, you're seeing that lower here out of the gate. That's down by about 0.3%, 0.4 if you want to round off at home and be a Grinch. But over the past 4 days, still net positive by about 0.3%. And S&P 500, you're seeing that in the green. That's up by about 0.8% right now. Over the past 4 days. However, here today, it's only higher by about 0.1%. We'll be generous and round that off too. Let's take a look at some sector activity just to see where things are opening up on a industry or a sector basis, if you will. And as there's been a lot of financial activity this morning and banks starting to report and really kicking off this earnings season. Financials, XLF, you're seeing that higher by about 1.25%. So some beneficiary action there for the overall sector. But bringing up the caboose here, you've got utilities. That's down by about 1.1% out of the gate this morning. But overall, as we were mentioning, the S&P 500 down by about 0.1%. So about as split as you could get for, of course, an 11 sector basis there. But as we'll continue to track that as we move on throughout the rest of today's trading session. Keep a close eye on technology here, folks. Why? Because you've got a lot of red on the screen there. Bringing the caboose, we'll dive into some of the EV manufacturers later on. Rivian and Lucid, though, out of the gate this morning. You're seeing both of those lower as of right now. I clicked on them both, so I'm glad that they both pulled up. That just means the Wi-Fi Interactive is active. And Fastenal, let's take a look at that. That is the biggest gainer here on the day out of the gate. It wouldn't pull up. That's okay. We don't have time anyway. Right now it's up by about 1.2% in the leaders in the Nasdaq 100.
Hey, that Rivian getting short-circuited there, Brad, on Piper Sandler downgrade. We'll have more on that really debacle of a company coming up. All right, Boeing shares are flying into some turbulence as the discovery of a parts compliance issue brings its 737 MAX deliveries to a halt. We're seeing Boeing shares really hammered here. Brad, down about 5% here. Losses really accelerating here throughout the early going. And very disappointing for Boeing. Just a couple weeks ago, I'll do a name drop here because it's Friday and feel like I want to do that. I talked to Dave Calhoun on a call. It's when they struck a big, almost $40 billion deal with Saudi Arabia. And he sounded like a confident CEO. CEO is always confident, but he sounded like, you know what, Brian, we're starting to get beyond the major problems, the production problems we have had. He told me that the supply chain was starting to improve. And then, Brad, you have news like this, and it's just like, wow, what is the state of Boeing, and when are they officially going to be just that good old-fashioned U.S. manufacturer that is steady Eddie, and maybe it's not today.
Yeah, into some of the numbers here. During the first quarter of 2023, they delivered about 113 737 MAXs. Of course, the news today is that they're going to have to halt and ultimately inspect for where Spirit AeroSystems and the kind of manufacturing mishap took place. But here's where the real issue is. The number of we mentioned 113 737 commercial airplanes in delivery that had taken place during the first quarter. That was out of a pie of 130 total, which means you only had one 747 get delivered. You only had one 767 get delivered. You only had 4 777s get delivered, and then 11 787s there. Now, at the end of the day, for Boeing, this is important to remember because between Boeing and Airbus, they make up essentially 90%, based on some Teal Group data, 90%, if not more than that, of the large plane orders internationally. And so with that in mind, I mean, this is significant because it really paints this picture, at least in the orders that Boeing has taken on, where there are still some of the uncoveries of where, and Spirit AeroSystems, this is not the first time that they've been in the news about one of these issues with regard to the production. So at the end of the day, I think it coming right back to that, it just goes once again against everything that Boeing's been trying to paint in this recovery story as well, which for the 737 had done well. I flew a 737 a couple weeks back.
You actually flew the plane?
I did not fly.
Oh, okay. I haven't been on the show in a while, so I've missed, I think, a couple things. But I thought, wow, what did I miss?
I got a lot of side gigs flying planes.
Okay, I just wanted to make sure that.
Yeah.
Wow. Oh my God.
I wish.
Oh, it's Friday.
Yeah.
All right, United Health out with a beat on the top and bottom lines, while also raising its outlook on full-year net earnings. And Brad, this is the beast of a company. I bet if you roll back the tape of us 3 months ago, 6 months ago, and then 9 months ago, talking about United Health earnings, we will have said the same thing. This is just a beast of a company that every single quarter seems to deliver, not only on earnings, but also in terms of raising their outlook. And really, I have to wonder, does the street truly understand what this company is doing and how fast they are growing? Over the past 5 years, you go onto yahoofinance.com, pull up a 5-year chart, shares up 135%. Pretty darn impressive.
Yeah, and one of the things that the CEO, Andrew Whitty, is calling out is high quality, affordable care and access to that specifically. Now, we've heard a lot of discussion in Washington, D.C. about where that needs to become even more affordable. And I mean, yeah, of course, there are a lot of pockets of the U.S. healthcare infrastructure that still people are priced out of at the end of the day. People need to have access to some of the basic services in healthcare, or just need to see costs of the prescription drugs that they need after a doctor deems them necessary for their livelihood to be available to themselves and at a lower cost and lower premiums as well. So all of that considered, one of the major call outs for the company, on a company basis at least, cash flows from operations, they were about 2.8 times their net income, and ultimately came in at about $16.3 billion here. I think this is going to be a big year to continue to track UNH and United Health Group across the broader conundrum that the healthcare industry faces.
Might be a big decade for United Health. Bottom line, we're all breaking down, Brad. We're not getting any younger, despite us all thinking we will live forever. Not to be all doom and gloomy on a Friday, but we're all getting older. We need services that this company is providing, and that is unlikely to change over the next 10, 20, 30 years.
All right, tee up the Terramana. That's not going to help me get any younger either. Guys, shares of Express, they're on the move after the fashion retailer, the fashion apparel retailer and manufacturer and global brand management firm, WHP Global, they announced a definitive agreement to acquire menswear brand Bonobos from Walmart. Okay, so I'm just going to put my cards on the table. I'll be very transparent about this. I have been very critical of Express, some of the SKUs, some of the clothing items that they've had. I love this deal. Why? Because I love bonobos.
Well, I have to give our head of news, Miles Ullin, a shout out. Now, I never heard of bonobos up until a couple of years ago.
Okay, all right.
Miles has this absolutely phenomenal blue suit, very slim fitting. He looks absolutely awesome in it.
They make great suits.
And he told me this is bonobos. And ever since he did, I went out and I stocked up on a whole wardrobe of bonobos clothing. It is high quality. And the fact this newly formed company came out here and they were able to buy this brand for only, $75 million off of a Walmart that never really figured out what they wanted to do with it. It was never truly integrated into the company. This might be a steal of a deal for this, and this is the first acquisition by this newly combined company.
$75 million, right, for the deal? You know what Walmart paid for it? $310 million. And that was back in 2017. And it's remarkable that Walmart wasn't really able to capitalize on, and it perhaps could have been a misread of what the strategy should have been going forward from them for bonobos. I've seen only for a long period of time, they had a lot of the kind of showroom type of store capacities where you walk in, you get fitted, you try things on, and then they'll just ship it to you. And they've got a great shipping and logistics kind of get it to you in 2 days type of ability for bonobos, but I don't know that Walmart was able to make sure that outside of logistics, was able to really capitalize on how well bonobos could have done, and perhaps Express will be able to give them kind of that next leg up.
Well, this was part of a brand or apparel acquisition spree by Walmart a couple years ago. They have now unwound that, and I like seeing Walmart do this, even though they are taking that sizable loss on the deal. This is continues to show that Walmart is a more focused company, reinvesting in themselves and what they do best. I like their recent investor today. They came out here, they stood up a new, highly automated factory, and I think they'll open more of those over the next couple of years as they try to get packages to people faster. They've put more items on their marketplace. Their online sales are surging. They're taking the fight back to Amazon. I like the fact they did this.
Yeah, absolutely.
All right, coming up, while big bank CEOs are speaking out on earnings calls, we are also getting some fresh Fed speak. More on this from our Fed correspondent, Jen Schomburger, next. It's been a busy week for commentary from top names inside the Federal Reserve, and that commentary continues today. Yahoo Finance Fed correspondent Jen Schomburger joins us. Jen, take it away.
Hey there, Brian. Good morning to you. Fed Governor Chris Waller, in a speech this morning, says the Federal Reserve has not made enough progress on inflation based on the latest data and that the Fed's job is not done. Speaking at a conference in San Antonio, Texas, Waller said, quote, financial conditions have not significantly tightened. The labor market continues to be strong and quite tight, and inflation is far above target, so monetary policy needs to be tightened further. How much more interest rates need to be raised, says Waller, depends on inflation data and the extent to which credit conditions tighten. Waller wasn't encouraged much by the latest inflation reading based on the Consumer Price Index, noting that core inflation did not show much improvement. On credit conditions, he says it's unclear at this point how much stress in the banking system following the failures of Silicon Valley Bank and Signature Bank will dampen economic growth. But he says all else equal, a significant tightening in credit conditions could eliminate the need for further policy tightening. Guys?
Jen, while we've got you, what were some of your takeaways overall from this week? I mean, we got a lot of Fed speak. You yourself spoke to the New York Fed President Williams.
Yeah, hey there, Brad. That's right. Two general takeaways, and you heard it there from Waller, which is that inflation remains much too high and that the Fed has more work to do. In an exclusive interview, speaking with the New York Fed President John Williams earlier this week on Tuesday, he says that the Fed has more work to do in bringing inflation down because of a strong job market. Take a listen.
So we're seeing signs of inflation slowing, but inflation is still very high. And I would just mention that, some of this core services inflation, excluding housing, that hasn't budged yet. So still got our work cut out for us to get inflation back to 2%.
And CPI inflation has been pretty sticky as Fed officials view it. San Francisco Fed President Mary Daly made such comments, saying that even though the headline number is moving in the right direction, core still remains elevated and inconsistent with a level of price stability. Now, the second theme this week, Fed officials are watching credit conditions closely, but they don't see many signs yet that it's really tightened substantially and is impacting the economy. Williams told me that he hasn't seen any impact on consumer or business spending or other parts of the economy, though it's still early innings and he is watching that quite closely. Now, we also heard similar messages from Waller as well as San Francisco's Fed's Mary Daly. And the new kid on the block we heard from this week, Chicago Fed President Austin Goolsbee, striking a more cautious tone, looking at these credit conditions as perhaps a greater risk than inflation right now, sending the message that perhaps the Fed needs to move a bit more cautiously in light of all this uncertainty. Guys?
Yahoo Finance's own Jen Schomburg. It's like just a few days ago you were up here in New York City. Now you're back on the telly.
Keep crushing it, Jen. Keep crushing it.
Thanks so much, Jennifer. We appreciate it. Bringing some good news for home buyers in our chart of the day today. Mortgage rates, they continue to cool this week. The average 30-year fixed falling for a fifth straight week, albeit slightly to 6.27% according to Freddie Mac. So where are we headed and what's the collateral damage of the past year on the mortgage industry? Let's talk about it a little bit. And actually, it's even more competitive than we may think. Of course, that national average still above, 6.7% as we were just talking about, and Freddie Mac data there. But even as you're looking through some of the more competitive lending platforms, even a bank rate right now is saying that some of the top offers are actually south of 6%, that they're more towards about 5.77% there. And so even as you think about the number of existing homes that still remain in this market right now, the inventory has essentially been unchanged based on the latest data from the National Association of Realtors, sitting at about 980,000 at the end of February. Of course, we need a fresh reading for the end of March, but at the same time, the existing home sales prices have actually decreased by about 0.2% as well from the previous year, right now sitting at an average of about $363,000.
I'm not even going to go that deep, Brad. I look at that type of rate, and I see this week that rents in Manhattan have hit a record over, I think, $4,000 a month, and it is still prohibitive in terms of in lodging, in housing. It's still hard to go out there and just, I think, live the life that you want to live because of higher interest rates making rents even more money. And look, I think rates and mortgage rates at these levels are still keeping a lot of would-be 35-plus-year-olds out of housing.
That's what I told my parents when I moved to New York. This is not going to allow me to live the life that I want to live.
I knew you were going to flag me on that statement, but I went all in, Brad, and that's okay because it's Friday and that's what we do.
That's fun. It's just fun. No, it's real.
Live your best life, Brad.
Well, I'm trying, man. But New York. Guys, coming up, we've got March retail sales showing a 1% drop from February following some slowing inflation data. We'll discuss with ADP's Neela Richardson next. We got a pulse check of the consumer this morning with March retail sales falling 1% from February as people pull back on spending despite inflation data showing signs of slowing. ADP Chief Economist Neela Richardson joins us now. Great to see you and get some of your insights as always. You know, really take us into your reading from this particular retail sales data and what it tells us about the consumer right now that's trying to still be healthy or resilient, as bank CEOs would say they are, while still trying to navigate a very moderating economy right now.
Well, hi, good morning, happy Friday. And I think what the data tells us is that the consumer is still in pretty good shape, that consumer spending is likely to still provide upward support for first quarter GDP, but higher interest rates and higher inflation are taking a toll. Now, you noted the 1% declines. Some of that might have been that January and February were warmer than expected and people were out and spending more. And so that spending took place earlier in the quarter, and the March is reflective of that. One of the big drivers of the decline was motor vehicle sales, 1.6% down from the previous month. And, you know, we've seen that indicator of auto sales really be sensitive to supply chain shortages, also now sensitive to higher interest rates. So dealing with lack of supply on last year, now transitioning that downward spending to higher interest rates and maybe not wanting to take on an auto loan at this time. The consumer is trying to navigate a lot right now, but still fairly resilient and still fairly supportive of GDP growth.
Neela, has Has the economy felt the full impact of the Fed's rate hikes?
Not in my opinion, no. I think those are lagged, and we all understand that. Interest rates are higher. They're not high in terms of historical trends. In fact, they've gone from basically rock bottom levels of 0 to around 5%. But they are high in terms of how quickly they've gone up. And I think that sticker shock on interest rates is still being reflected in the economy. And as a data point, I would note the recent New York Fed survey tying interest rates back to inflation. That consumer expectation survey said that consumers are still expecting higher inflation. It went up again. And so there is a balance here between higher interest rates slowing down spending and consumers' expectation that price growth will continue.
To what extent is the expectation of price growth and the actual kind of incurring of price growth, because it's still a purchase decision that consumers make, whether on the necessity or the kind of discretionary side there. But as we've seen some of those discretionary dollars start to wane a little bit, it is a matter of where they're pushing back on price, where we're seeing more discounting, and where consumers also might feel confident in the wages that they have too. So if there is a correlation between those wages and between where inflation is still sticky, what is your reading into that?
Inflation, it's a great question because inflation has morphed, right? It started with a supply chain shock, but it's being amplified and held up by increased wages. For the worker, though, the translation doesn't matter because they're still seeing their dollar go less far on average than it did a year ago. But what we're seeing in terms of payroll data is that our wage growth is starting to decline. That's good news for inflation. The question is always a horse race, though. Is inflation dropping faster than pay growth is dropping? And that's what makes workers able to spend more. Right now, spending still looks supported, but inflation hits low-income workers, low-income households the hardest. And they're not just dealing with discretionary issues. They're dealing with things like food, which we know has seen really outsized growth in terms of prices over the last year. So that is still weighing on low-income households. Yes, they've seen the fastest growth, but what they're spending most of their budget on, food, shelter, things that you can't substitute out of, those of what we've seen in terms of consumer prices really take flight.
Are CEOs or companies, I should kind of broaden that out a little bit, are companies right now continuing to try and push a supply chain issue type of story or narrative, or them needing to pass on more wages type of story, in terms of the amount of prices that they're continuing to keep elevated right now? Even in the face of consumers saying, you know what, we're kind of pushing back on that price, are they doing it to kind of maintain their own margins? And how do you expect consumers to continue to respond to that if they indeed find out that, hey, the supply chain is just fine now? Stop using that as almost an excuse.
I think it depends on the company and the size and the industry. For small firms, finding qualified talent and keeping up with the wage increases has been top of mind, a front burner issue, much more than supply chain issues if you're in the service sector. So for small firms, it's about wages, wage growth, and the competition for talent. For larger firms, they've pretty much overcome the period where there is an immediate hit to supply, that these supply chain shortages had to be dealt with real time. And they're dealing with a structural change, a longer term change, rethinking supply chains in a more strategic way, which will add cost if it increases resiliency. So every company, depending on size, are on a different part of their journey when it comes to prices. But when it comes to the consumer, consumers don't care if you're raising prices because of higher labor costs or raising prices because of supply chain woes. When they're in the grocery store, when they're in the department store, all they're seeing is the higher prices.
All right, that is ADP Chief Economist Neela Richardson. Great to have you here with us today, and especially as we're continuing to keep a close eye on where some of the economic data readings continue to trickle in, of course. Thanks so much for joining us.
Thank you.
Absolutely. All right, everyone, we got to take a look at some trending tickers that we're watching for you on the day. well, we've got the full list pulled up here for you, but I did want to scroll on down to one of them that was getting a ton of attention earlier on as things are kind of moving around, as people are continuing those searches on Yahoo Finance. Let's take a look at Lucid first, and we'll kind of pair this together between Lucid and Rivian. Saz, we had been tracking this one earlier on today. Lucid right now, that's down by about 9%. I did want to get back over to Rivian though and really showcase what is taking place there. Of course, as we continue to track, and I'll just go over to the EVs here. Rivian, that's down by about 5.2% right now. And this was off of one of the calls that we're seeing really this activity stem through from as well.
What was interesting about the Piper Sandler call on Rivian, they said Rivian is going to need a capital raise. It was right at the top of the report. Now, Rivian has pushed back on this view that it will need to raise more capital to achieve what it wants to achieve, which is making EV trucks at scale. So a big call out by Piper Sandler, and that person was a longtime bull, so very just not good.
And important to remember kind of the pairing through for a company like Rivian and Lucid. Of course, they're at the higher tier in terms of the pricing strategy that they have for anything from the Rivian R1T or their pickup truck, their electrified pickup truck, and Lucid also at the high-end price tier of that. That's down by about 9% here on the day as well. And then just lastly, I want to take a look at some of the crypto. I was keeping tabs on Marathon earnings. If you're on the trending tickers part of our website, you'll see Marathon on the move. That's one of the top trending. Ethereum, that actually is up 5% on the day. That's just got its Shanghai upgrade completed as well. So we're seeing some movement in that cryptocurrency landscape as well. Ethereum, one of the outsized moves coming up, how consumers are really feeling about the state of the economy. We've got some fresh economic data next. Welcome back to Yahoo Finance Live this morning, everyone. I'm Brad Smith alongside Brian Sazi. Julie Hyman has the day off. Let's get right to some breaking news on consumer sentiment that has just crossed. And as of right now, we're seeing some of the preliminary results for the month of April 2023. Those coming in at 63.5 for the index of consumer sentiment there. And then additionally here, On the index of consumer expectations, that coming in at a 60.3. Now here is what's more to know about this. This is actually a move higher from the month of March. We were sitting at 62.0 during the month of March 2023. And one of the interesting things, as this was essentially unchanged this month in consumer sentiment, as the Survey of Consumers Director noted, this is inched up less than 2 index points from March. Sentiment now at about 3% below a year ago, but 27% above the all-time low from last June. Interesting note there. Consumers also, they're noting, have seen some of the easing of inflation among durable goods and cars. I know that was one area that we've been tracking over the course of this week, but they still expect high inflation to persist, at least on the short run. And on net, consumers did not perceive material changes in the economic environment in April, they're saying.
Yeah, I think this consumer sentiment report, Brad, fits with what we heard from the Fed member Waller this morning here, saying inflation still remains very high. In this report, Michigan sentiment noting year-ahead inflation expectations rose from 3.6% in March to 4.6% in April. Very interesting. That is coming despite the Fed's series of rate hikes going back more than a year, but does come alongside higher oil prices and higher gas prices, in large part because of those production cutbacks from OPEC a couple weeks ago.
Yeah, rare that you see the use of the word seesawing, but I'm going to give it a mention here. These expectations have been seesawing, as they went on to say, in 4 consecutive months, alternating between increases and decreases, but they said some uncertainty over the short-run inflation expectations continues to be noticeably elevated, indicating that the recent volatility expected in year-ahead inflation is likely to continue here. So pair that with what we're also continuing to hear about the health of the economy from some bank CEOs that have released earnings here on the day and as we kick off earnings season as well.
All right, crude oil prices are tracking toward their 4th straight week of gains on the back of further signs of tightening supply. How will supply deficit risk, how will that hit you as consumers? Here to discuss this and more is Pavel Molchanov, Raymond James Managing Director. Good morning to you. And so we were just talking about this inflation report from Michigan Sentiment. Inflation expectations high, and I would argue that's because of the move we have seen in oil prices and, of course, gas prices. How long do you think this will continue?
Well, the fact that OPEC responded to the year-to-date weakness in oil by cutting supply, as you noted 2 weeks ago, was actually a very timely reminder that supply-side risks have not gone away. For close to 100 days, oil prices were falling because of all the macroeconomic demand headwinds that we are familiar with: monetary policy, inflation issues, corporate layoffs, and so on. So along comes OPEC, cuts supply, prices have jumped, but keep in mind they're only back to where they were at the beginning of January. So it's not, it's certainly nowhere near the level of prices we had last summer when oil peaked at $120 a barrel. And, we are still, way off from that level. $80 to $90 is a manageable price. It's not that different from where prices were, if we go back to pre-COVID in 2019.
What does this mean in terms of the number of heat waves that we're also expecting this summer?
Well, heat waves are not going to directly move oil prices, but they are very relevant for natural gas. Mm-hmm. And let's, take a step back. Europe in particular experienced an epic energy crisis last summer. Obviously, in the context of Russia's war in Ukraine, the Kremlin has been and continues to weaponize the supply of natural gas, cutting it off to the European market as a deliberate political strategy. Now, that strategy has failed in a political sense, but it certainly explains why Europe continues to have the world's most expensive natural gas. Ironically, this winter, which was very warm, Europe's energy crisis subsided, but we need to watch carefully what happens this coming summer when the heat waves will return. Last summer, Europe had the worst drought in 500 years, which disrupted, for example, hydropower and even nuclear. any rerun of that would bring back the energy crisis.
Pavel, in this environment where oil prices are on the rise, gas prices are on the rise, are there certain companies within the oil industry that might show outsized profits compared to others?
Well, the entire petroleum, oil and gas value chain is obviously benefiting from higher commodity prices. So for the producers, E&P companies, they are just swimming in cash flow. They're also, by the way, much more capital disciplined than they used to be 10, 20 years ago. E&P companies are no longer reinvesting every dollar they bring in. They are giving back a lot more in the form of dividends and share buyback, which shareholders love. Helps explain why these stocks have actually been very resilient even during corrections in the oil market. At the same time, pipelines and drillers are benefiting from the fact that capital spending is increasing. Again, not as much of a capital spending increase as what we would have expected a decade ago. But again, the entire food chain is benefiting from very healthy fundamentals in oil.
As it's becoming more clear that an energy, or at least a clean energy transition, is going to take longer than expected, or at least hoped for as well, for humanity's sake, at the end of the day, for investors who have a long-term time horizon, what should they be keeping tabs on with regard to where that transition also impacts some of these oil companies that they may hold in their portfolio?
Well, look, it's pretty clear that fossil fuel demand will not grow forever. Coal is already on its way out. It's just a matter of how quickly. In the U.S., for example, coal used to be 50% of electricity. Now it's barely 20%. Europe's even less than that. Global oil demand will eventually peak. We do not think it has peaked yet. It'll probably closer to the end of this decade when that peaks. Of course, electric vehicles are helping to speed up that process, but oil demand still has some room to grow. And then probably natural gas has even more room to grow because, of course, that's a cleaner fuel than either oil or coal. But all of the fastest growing energy sources are renewable, solar, wind, bioenergy, green hydrogen. This is where so much of the incremental energy demand will be coming from. Oil companies know this. This is not a secret. And in fact, particularly in Europe, 1/3 of the capital spending by the big oils is already clean, low carbon, sustainable energy sources. The US, Saudi Arabia, we're not nearly as advanced in energy transition as Europe is. But if you talk to the US-based big oils, they're well aware of this megatrend. They are on the energy transition bandwagon, just not to the same degree as the European players.
Pavel Molchanov, Raymond James, Managing Director. Good to see you. Have a good weekend. Shifting now to some commentary out by JPMorgan CEO after the company saw a 52% increase in profits, aided by higher interest rates. But while current rates provided JPMorgan a lift to its bottom line, CEO Jamie Dimon warning in this morning's earnings call of the risk of higher rates for longer.
There is a risk of higher rates for longer, and don't just think of just the Fed funds rate, because I think you should. For our planning, I'd be thinking more about it could be 6, and then think about the 5 and 10-year rate, which could be 5. And I think if those things happen, I'm not saying they're going to happen. I just think people should prepare for them. They saw what just happened when rates went up beyond people's expectations. You had the gilt problem in London. You had some of the banks here. People need to be prepared for the potential of higher rates for longer. If and when that happens, it will address problems in the economy for those who are too exposed to floating rates or those who are too exposed to refi risk. Those exposures will be in multiple parts of the economy. So now and I say to all of our clients, now would be the time to fix it.
Good for Jamie Dimon pouring a little cold water on this bank stock rally here. I think this is a very rational, well thought out thesis by Dimon. You see the market rewarding a quarter of higher rates impacting profits. But I think what Jamie Dimon is saying, hey, well, you know what? If rates continue to rise and we may get another rate hike at that early May Fed meeting, that is going to have a major impact likely on the economy. And maybe we're having this conversation 6 months from now, talking about third quarter earnings that are in no way as strong as the first quarter.
Well, Jamie Cumulus Dimon has continued to be the storm cloud, or at least the meteorologist here in the economic framework that has continued to say and downgraded, thankfully, from the hurricane that he was calling for.
I kind of like the hurricane. It was kind of fun.
I mean, it was
a good headline.
It was a good one. Yeah. But, I mean, this is a clear acknowledgement of them not being in the camp of a no landing scenario. And quite frankly, in their earnings release, they had talked about versus a hard landing or a soft landing scenario, either one. Both of them are going to impact rates and loan growth here. And so, with that in mind, and all of the customers that they do serve, whether that be on the wealth management side or whether that be on the consumer community banking side, all of them should heed what Jamie Dimon is saying on this call, because in one facet or another, it's going to have a major matter, or at least a factor in the decision as to whether or not the bank chooses to do business with the small business or the mid-sized business or the individual who's looking for that loan for a favorable term, which they may not get.
Well, if there's anything positive here, Brad, rates are unlikely to reach 15% plus, as my parents bought a house in the early 80s. So, we got to keep it positive. It's Friday.
It
can't be all storm clouds and rain, you know?
I mean, what were houses back then?
Not as much as they are now.
Average price was like $120,000.
I learned today you fly planes, so that's very exciting. All right, coming up, Piper Sandler is hitting the brakes on Rivian, urging the EV maker to address funding concerns. We'll break all of that down next.
Small business owners have faced numerous challenges in the past couple of years, but luckily there are some tax credits and deductions that would do to help. Here are our top 3. The first one is an Employee Retention Credit, commonly known as an ERC. It's a pandemic-era credit established to help employers return their workers during this era, and each qualified employees can claim up to $26,000. Although this credit was a COVID-19 relief benefit, business owners have 3 years from their original tax return to go back and retroactively claim this credit. The next business credit on our radar is the bonus depreciation. In 2022, small business owners can claim 100% bonus depreciation. What this means is if you have a qualified asset, instead of waiting for a period of time to expense them, you can write off the entire thing in just 1 year and without having to wait. The bonus depreciation rule does start to phase out next year, so make sure you take advantage of it before then. The last one is the 100% business meal expense. In 2022, business owners can deduct any qualified business-related costs relating to food and beverages bought in a restaurant. The IRS also allows any tax and tips included in the deduction. However, do be aware that these meals should not be lavish or extravagant.
Talk about hitting the brakes on a stock call. Rivian now with a downgrade from longtime Piper Sandler bull Alexander Potter, citing funding concerns at the electric pickup maker. This is automakers assess their dependence on China for EV materials and continue to roll out more EVs. Here with more is Yahoo Finance senior auto correspondent Praz Subramanian. Praz, let's start with this call on Rivian from Piper Sandler. They were a longtime bull in this name, but right off the top, they're saying, you know what, we're pushing back on Rivian's view that they don't need more cash and they will probably need more money to reach their vision.
Yeah, so you know, first of all, downgrade is neutral. $15 price target from 63, so pretty big decline there. He once had an over $200 price target on Rivian, so you know it's come down a lot. Bottom line, saying that investors are unwilling to pay now for future long-term profits, prioritizing cash flow, and that also means $4 billion in new funding for Rivian is what he's anticipating down in like 2024, 2025 as the company ramps up its strategy. You know, and he's not actually knocking the strategy, he's saying like, you know, going fully integrated here like Tesla, you're buying your own factories, you're making your own parts, you're building your own cars, eventually will be cash flow kind of, not cash flow, but it'll be more economically God, I can't, sorry now. It'll be more economically,
we're all, you know,
make more sense economically if you build your own factories, all that stuff. But yeah, $4 billion funding hole there. Company has $12 billion in cash right now, so they're not really in dire straits yet, but I can understand where he's coming from as at this point.
The new EV tax credits, they try to encourage American-built vehicles, but automakers, are they finding it hard right now to wean themselves off Chinese manufacturing, and if so, why?
Yeah, you know, this is the Joe Manchin effect in the IRA, right, where they wants automakers to wean themselves off of Chinese and foreign entities of concern materials. So in the IRA tax credit, the battery component has a sort of percentage for the critical minerals and where they're made. For some automakers, this is a problem. Tesla has said they might actually see their Model 3 base edition lose half of its credit because of that battery thing. So that's a component, a problem there. But, you know, at the end of the day, an automaker can make a car anywhere they want in the world with whatever materials, and they just won't get the tax credit. So that's sort of the balance there.
I love seeing these auto blogs here today, Praz, talking about Tesla, making a big deal out of Tesla not appearing at the Shanghai Auto Show. That is next week. And then I thought about it for a second. Well, maybe they just don't have anything to show. So, I mean, they're not actually turning out all these new models like a GM or Ford.
Yeah. I mean, it makes total sense. They only have two models there, the Model Y and the Model 3 there in China. They're not updated.
And they have the Cybertruck rolling around, one Cybertruck rolling around California somewhere.
Yeah, exactly. Every day we see photos of it. But yeah, I said it's not their thing to go to auto shows. They got nothing to show. They're already big in China. They already sell potentially their most vehicles are sold in China anyway, so not necessary. But if a new, I think they went to Thailand because they had a new market there. So they'll go to a show if it's a new market. But otherwise, they're going to kind of do their own thing.
I mean, but wouldn't it be remarkable if they finally kind of unhooded or unveiled that car that had basically the Casper sheets on it at their previous investor day that took place too.
Right, the Gen 3 car, yeah.
The Gen 3, whatever it may be.
Yeah, I mean, we don't have any idea when it's coming. It could be tomorrow or 5 years from now.
They should have just stood up one of those robots and brought it to the Shanghai Auto Show. One of those robots, Optimus robots. I'd go watch that. That's pretty cool.
Optimus is scary.
I want to see that. Yeah, I'm ready to see that, yeah.
All right, Yahoo Finance's own Praz Subramanian. Thanks so much, Praz. Coming up, everyone, how artificial intelligence, speaking of Optimus, is impacting education. We'll speak with the CEO of Coursera next. College enrollment is on the decline as the rising cost of tuition deters students from taking that path towards a degree. But another rising phenomenon may also have an impact here. It's artificial intelligence. And as concerns around the future of the job market rises, for more on the state of the education and technology space, we're joined by Coursera CEO Jeff Maggioncalda. Jeff, great to speak with you as always. Absolutely. When we think about the kind of broader educational economy right now, this is one of the highest or most exported U.S. commodities as well that we have to think about here. And so with that in mind, how has artificial intelligence changed the thought process for students around what type of degree they're pursuing, how much they're willing to pay for that degree, and what their studies look like?
Yeah, I think it's not really going to so much change, I think, how students go about picking a college degree. Generally speaking, what people say is, where are the good jobs and what are the schools and degrees that can get me a better job or advance my career? I do think it is changing where the good jobs are going to be in ways that we don't really know for sure. I gave a keynote yesterday, and what's interesting is if you look back to 2016 and the AI that was available at that time, the big impacts people were expecting and what we're seeing is people with less education are more impacted by more traditional AI. But the new class of AI, this generative AI, especially ChatGPT and other generative language AIs, it's going to have the biggest impact on people who have college degrees. And so a lot of the things that we think or thought weren't very predictable and able to be done with machines is looking like machines can do those things. So I think a lot more investment now in broader human skills with good fluency in data science and computer science.
Jeff, could you break down for us how you are preparing your company for this change?
Well, I mean, internally, what happened was as I was sort of following GPT-2 and GPT-3. I mean, our engineers were kind of banging on it, and through APIs, an engineer could hit those services. Once ChatGPT came out, a couple things happened. Number one, I could personally use it myself, and the model underneath it was a lot more effective. So I mean, as soon as I used it, I was like, this is a total game changer. I'm an English major. I could not believe the facility that it could create language. So we immediately created a team. Well, actually, there's already a team, but we really escalated. I put together my executive team. We spent a ton of time thinking about how to respond. Yesterday, we previewed 3 major advances using AI that we're rolling out in the coming weeks. One is a coach to help people learn. One is a course builder to help people build content. The third is machine learning translation to make courses available to basically anyone in the world who speaks almost any language.
What do you forecast or perhaps project the financial benefit of generative AI could be for a company like Coursera? How does it change the total addressable market?
Well, I think one major thing that it does, and we had machine learning translation before generative AI, but it's sort of a different approach to translation that really increases the quality of machine-based translations. Translating a course with humans was about $10,000. Now it's about $20. The quality still needs to be a little bit higher, but generally speaking, the global addressable market, when every course can be available to every person who speaks almost any language, that clearly helps. The cost of content production also will come down dramatically, and the speed. So I think there's going to be a lot more content, and what people are going to be looking for is, who can I really trust, and what kind of a credential can signal that I have the skills that employers are looking for?
Jeff, how dangerous is AI?
I mean, in my opinion, I'm pretty worried about it. What we're doing at Coursera, we're implementing it really as a learning coach. And so it's all grounded in content on these courses that really expert professors and industry leaders have put together. So for us, it's just like a really smart tutor that can read all the material and explain it to you. But once AI starts controlling systems, then you got to be really thoughtful about what's the optimization that AI is pursuing. Some people call this alignment. But if it can control important systems and those systems can kind of garner resources, we really have to make sure that we understand what objective the AI is pursuing and what is our ability to monitor and control AI's control of that system. So that's what I kind of worry about is systems control.
If there is the fear about AI as well, not just from yourself, I mean, this has been talked about among some other tech CEOs that have come forward for better or for worse, and some of them have been openly criticized about that too. then why are we moving so quickly towards a future where generative AI is embedded within everything from cybersecurity to some of the very search functions that we use on a day in, day out basis?
I think it's a few things. Clearly, AI presents an incredible new set of capabilities. I mean, to me, somewhat scary new capabilities, but they are really powerful capabilities that can create a lot of value for customer, can do things that we never thought possible. The idea that every single person in the world could have a multilingual expert AI tutor teaching them things that are difficult for them to understand. I mean, it's kind of revolutionary. So it really does afford a lot of benefits. But there also are dangers. I think one of the things that's happening, though, is because the power of AI is so obvious, countries don't want to fall behind in the race, and large companies don't want to fall behind in the race. And so I really do think there is an AI race going on at the geopolitical level and also at the company level. And so, nobody really wants to slow down because there could be big disadvantages of losing that race, advantages to winning the race, but no one's really pacing the race because, no one wants to set themselves at a disadvantage. So, I think what we need to collectively do pretty quickly is try to figure out what are the boundaries of where we want this to go and where we need to come, kind of pull back and make sure that the dangers don't exceed what the benefits are going to be.
Jeff, we spoke with IBM Vice Chair Gary Cohn earlier this week, and I asked him about what artificial intelligence as an economic input would look like and what that means for the employment situation, too. I want to play this quick clip and then get your feedback and your response on the other side.
We have seen very few things in our generation that have really changed worker productivity. What's in front of you, the laptop or the computer, was the last major shift in worker productivity. AI and machine learning could be the next big leg in worker productivity.
And the next thing that I asked to him thereafter, I'll also pose to you, which is, does that productivity come in tandem of or in replacement of the existing headcount at certain companies that are going to look to roll out artificial intelligence?
I think it's going to be both. My sense is what's happening, and this was true on the mechanical side with more traditional AI that controlled machines that could repeat tasks. These are kind of like machines that will start repeating or essentially automating cognitive tasks. Entry level, so there's a whole new class of activities that are going to be automated. These are sort of cognitive activities of writing and synthesizing messages, summarizing things. But it feels to me like what's going to happen is the first set of tasks that will be most easily automated are those associated with entry-level jobs that are very heavy in media, in language, in audio, in images, in video. So entry-level jobs that deal with those things are going to largely be automated. Experts who can control workflows of those things and can understand context of a business, context of a customer problem, to deploy those bots to create value for customers, I think that they're going to be far more productive. So I think there might be a bit of disparity. Experienced people who understand business context and customer issues will be able to use these types of tools to dramatically expand their productivity. Entry-level folks, I think, are going to have a tougher time getting into positions because they don't have the context and experience from the business, but a lot of the cognitive skills that they could bring are able to be done pretty well with AI. So I think there's going to be a bigger future for apprenticeships and training programs to give newer employees in a company the kind of context that will help them be more productive. And I do think that it's definitely going to replace some jobs. I mean, if everybody is 5 times more productive, I just don't see how that might, I'm sure that's going to have some impact on the number of people that companies hire.
And it has an impact on the type of jobs that people start to train themselves for as well here. We actually put this to a poll for some of our viewers here. And here's a look at some of the results. Many people trying to figure out if this is a cause for concern in the job market. And the majority of them, at least for this poll, saying yes, it is definitely a concern. And it was interesting, the second largest response of the poll was depends upon the career, which is kind of mirroring what you're saying. So what are the types of careers and then thus the types of degrees that people are probably going to opt out of and decide to go in a different direction as a result of AI?
Yeah, there was a great report that just came out March 27th from OpenAI and University of Pennsylvania. And what they looked at all the different job categories and said, what is the exposure to each job category, kind of like a career, to GPT-4? And, there were some jobs that weren't really affected, but these are stonemasons, slaughterers, certain types of construction jobs, and not all super high paying jobs. So it does depend on the career a little bit, but I'll tell you, once you can automate all physical motion or a lot of the repetitive motion, that's a lot of manufacturing jobs. And then once you can automate almost all entry-level media-based tasks, that's a lot of the people with college degrees. It's a lot of careers that are going to be impacted, not necessarily eliminated, but impacted.
Right.
To your question of, well, what skills should people be learning? There was a great report that just came out from McKinsey fairly recently where they looked at what kinds of human skills will be most important to be effective in the workplace. It's things like critical thinking, teamwork, collaboration, adaptability, dealing with uncertainty, storytelling, influencing, things associated with working with people.
Does that mean that AI should bring down the cost of a college education?
No doubt about it. Absolutely. In fact, we talked yesterday about a master's of science and data science from University of Colorado Boulder. Great school, $15,000 performance-based admissions where you can start the degree using open content on Coursera for $49 a month and actually finish up a master's fully online for $15,000.
All right, we'll leave it there. Coursera CEO Jeff Maggioncalda, always good to see you. Have a good weekend. We'll talk to you soon.
Nice to see you. Thank you.
All right, coming up, I sat down with the Carlyle Group's co-founder, David Rubenstein, to discuss the state of the U.S. banking system. That is an interview you will not want to miss.
As we head into bank earnings, there's a phrase you're probably going to hear a lot of. It is net interest margin. So we want to tell you exactly what that means. It's the difference between the interest that a bank pays out and what it brings in. So in other words, a bank takes in deposits from you, from companies, and it pays interest on those deposits. So that's the money that it pays out. Then it also loans out money to you, for your home, for example, to businesses, and then it collects interest as a result of lending out that money. The difference between those two numbers, that is commonly referred to as net interest margin. So in other words, if I'm depositing my money in the bank and collecting 3% interest on that, and then also if I am borrowing money from the bank for whatever it may be, and I'm paying 7%, say, on that loan, the difference between those two, 4%, that's the net interest margin. But to get a little wonky for a second here, the technical definition then takes that number and divides it by the average earning assets at the bank. All that means is all the other stuff on the balance sheet that doesn't really move around that much, stocks, bonds, etc., that's where you get the net interest margin. It's also especially relevant right now with a period of rising interest rates. Why? When interest rates start to go higher, more people want to put their money in savings at the bank because they're getting actually some interest on that for the first time in a long time. And maybe fewer people want to borrow money because it's more expensive to do so. So it's particularly relevant right now, and we're going to hear a lot about it once the banks start reporting.
Carlyle Group co-founder David Rubenstein is voicing concern on the finances of First Republic Bank. I talked with Rubenstein at length about the state of the U.S. banking system and the outlook for Fed policy. David, good to see you again. Last time I saw you, we were freezing in Davos.
I know. It's much better here.
Yes, indeed it is. So lots to discuss with you. Your new series, Iconic America, I'm very excited about it. It is everything that I very much like to watch, focus on history. But let's start a little bit more on the markets and this world of business and finance. This is the first time we have talked to you since everything that happened in the banking sector in March. What are some of your thoughts as you watch that played out?
I think the federal government did a reasonably good job of patching up the problem once it arose. Now, you could argue that they should have been on top of it before it arose, and the San Francisco Federal Reserve Board maybe should have been more closely monitoring Silicon Valley Bank. But on the whole, I think the U.S. government did a reasonably good job. They protected depositors. They did not protect creditors or shareholders. And I think in Washington today, it's very difficult to get enough political support to protect creditors and shareholders. It's easy to get support to protect depositors, though.
You talk to a lot of leaders. How do CEOs of these banks, how do they get in a situation like that?
Well, hindsight's always 20/20. I think in this case, Silicon Valley Bank was obviously growing very, very rapidly, and they had a business model that seemed to work, which is to lend money to venture capital firms and then require them to keep about 85% of the money in their bank. And then they put that money in treasury bills, which became worth less because as interest rates were going up, the bonds were going down in value. So they had a problem that maybe somebody should have picked up on earlier. But we don't have a contagion problem as much as we might have thought we were going to have. And clearly there are other banks that have some trouble now. I think First Republic Bank is clearly on a watch list, and probably somebody at some point will buy it. But the challenge there is it needs government assistance. There's a big hole in the balance sheet of First Republic Bank, I've been told, and therefore I suspect the government will have to provide some assistance if that deal is going to get done.
Are there safeguards banks can put in place to avoid a situation like this?
Well, sure, and banks do put safeguards in, but in this particular case, I think the banks were growing a little bit too rapidly. And I think under the law, even though there is some view that you've reduced the requirements for smaller banks, the Federal Reserve has, under the existing law, the ability to go in with smaller banks and make them put in more capital. I think here, probably the Federal Reserve Board in San Francisco probably should have been more on top of it, I suspect.
If First Republic does get sold, like you hinted might happen, and now a bigger bank gets even bigger, does that present risk to the financial system?
Well, the biggest banks in the United States now are pretty well capitalized, for sure. We don't have the problem we have in 07, 08. There's always a problem that something big can happen to somebody who's very big. But right now, as I look at the big banks, I think they're in pretty good shape. Now, the European banks may not be quite as strong as the American banks. I think the American banks really rebuilt themselves much more after 07, 08. Obviously, we saw Credit Suisse went under in effect when UBS had to buy it. I think the other banks in Europe are in reasonably good shape.
What goes through your head when you see a UBS scooping up a Credit Suisse? That weekend was just wow to a lot of longtime people, I think, in the financial services
Credit
industry.
Suisse has been around for over 100 years, and all of a sudden it's gone tomorrow. So nobody could believe that was going to happen so quickly. And obviously there's now litigation about it, but I suspect the deal will probably go through. The European banks have a different situation than the United States. They have different banking regimes, and so each one is different. In the United States, we have one federal regime that really makes the rules. In Europe, there are different rules for Germany or France or Italy, so it's a little more challenging.
Is all of this over?
Is all of this over?
Turmoil.
Turmoil is never over as long as markets are open. There's always going to be somebody finding something wrong or somebody trying to do something that maybe they shouldn't do. So I think right now the worst of the turmoil for the banking sector in the United States, I think, is probably behind us, but it'll be almost completely behind us when First Republic is resolved.
The Fed has really, some would argue, created the situation with the banks by aggressively moving with interest rates and hiking them up. If they continue to move, lifting rates even more to squash inflation, which is clearly still there, what do you think the aftershocks will be?
I think the Fed is determined to get inflation down to 2%. Now, some would say maybe 3% would be low enough, but the Fed has said 2%. And as a result, they are tunnel vision focused on getting that done. So there are side effects on that. Side effects are sometimes when you increase interest rates that much, you're going to have higher unemployment, which they recognize. You're also probably going to have a slowdown in GDP. And you might have banks that are a little bit shakier as a result of this. Historically, when interest rates went up, banks actually did better because they can charge more. But now we see that some banks were doing some things that maybe they shouldn't have done, and as a result, the higher interest rates were making the securities they own worth less, and that produced this problem that we saw at Silicon Valley Bank. On the whole, I would say interest rates are going to continue to go up for a while. I suspect in May, well, I don't really know, but I suspect in May, when the FOMC meets, they'll have another 25 basis point increase. The markets would suggest that that would be enough for the rest of the year, but you never know. If inflation rears its head again, maybe in the fall they would have another rate increase.
Is the series of rate hikes the Fed has put in, is that recession-inducing?
The theory of economics is when you increase interest rates, you decrease GDP and you also increase unemployment. That theory hasn't worked yet in this particular situation because the GDP has not gone down all that much and unemployment hasn't gone up at all. If anything, it's gone down. So people are scratching their heads at the Fed, say, how much more can we do to get the GDP to slow down? Maybe we don't want a recession, but GDP slows down, inflation goes down, unemployment goes up. That's something we can tolerate up to a certain level. the economic theory hasn't been working so far. And that's in part because there's not enough workers in the labor force, probably. And as a result, it's a very tight labor market. It isn't the same that they normally are going to see when they increase interest rates. Unemployment does go up, but now it hasn't been.
Are you surprised by the resilience in the broader stock market?
I've been surprised that the market has been as resilient as it has been, only because normally when you see this kind of dramatic rise in interest rates over the last 12 months, you would expect the GDP to go down, and you expect people talking about recession more than they are. But recessions were predicted for this year by many people. So far, it seems unlikely we're going to have a recession this year, or less likely than people once thought.
One of the things we hear from a lot of strategists and people on Wall Street is that the Fed may have broken something. It is unclear to me what that means when we hear that from these folks. What does that mean to you? And do you think they have broken something because of all these rate hikes?
The Fed had, and by its own admission, they thought the inflation that came about because of the $5 trillion injected in the economy because of COVID, they thought that would be a transitory inflation. And Janet Yellen said that, and Jay Powell said that. They now admit that was not right. It was not transitory. So I think the Fed probably missed the boat there because they've kind of thought this would be, as they say, transitory. It turns out it was more enduring. Now they're in an effort to get the enduring inflation down to a 2% level again, which is what we had for 25 years or so. I think 2% is going to be tough to get to, but that's what their target is.
So while David Rubenstein is watching all things finance and talking to his network, Brad, he does say that he has an interview coming up. He's also, of course, a noted interviewer with Kim Kardashian, and I told him I think he's going to break the internet with that one.
Well, she's already done that, so that would make the second
I
time.
can't wait
for
to
her.
watch that one.
First
though.
time
That's
for him,
great.
perhaps.
Yeah.
It was interesting what he was saying, though, about the projection for inflation perhaps rearing its head again in the fall, and you'd think of what that would actually mean. If inflation was to rear its head again in the fall, that would mean that it's really more towards the tail end of the summer, that much of that would have already been consumed by the broader economy because of the data lag. We wouldn't see it until early traces in the fall. That would also then extend the timeline of quantitative tightening, which is something that Jamie Dimon brought up in their outlook and the firm-wide outlook for what they're watching in the rate of quantitative tightening and how that impacts what a landing scenario looks like as well. And so if we did see some type of rearing of the head again of inflation in the fall, it's really a question of, okay, what is the concerted action from the Fed at that point? And then does that further kind of from the investment standpoint push out the timeline for a larger broad-based stock market recovery as well?
Well, it means another rate hike. So the Fed is, right now, the way the market is pricing this, we get another rate hike in that early May meeting, and then the market thinks the Fed will be on pause for the rest of the year. But you bring up a very good point. If inflation rears its ugly head, we could be back to a new round of rate hikes. And it's hard to believe that the market will like hearing that, especially as we sit here today. This is a market thinking that after this next Fed meeting, we are done getting rate hikes.
And that would be one of the biggest levels, if not the biggest level of uncertainty at that point. We know the markets don't like uncertainty.
Indeed. All right, you can catch the full interview throughout the day here or on the Yahoo Finance homepage and YouTube, of course. That is with the Carlyle Group's co-founder, David Rubenstein.
And coming up on the other side of this short break, are electronics the recycling problem here? We are going to speak with the CEO of Back Market on why tech could be an environmental concern. That's coming up next. Here's something to think about as you celebrate Earth Day. Well, first, those AirPods that you keep losing, they're filled with toxic minerals and chemicals and are too small to be scrapped for parts. That new iPhone that you're eyeing, your old one is contributing to the 420 million metric tons of electronic waste generated worldwide over the last 8 years. Refurbished electronics, that seller back market that you know of, says it has part of the solution with a renewed focus on recycling, but is a cheaper price. Is it enough to sway consumers away from the latest and greatest here? Here with more, we've got Thibaut Delaros, who is the back market co-founder and CEO. Thibaut, great to have you here with us today. First and foremost, just for the people that are trying to contribute more or be part of the circular economy, what's the first thing that they need to do? What's the first step that they can take?
Well, the first thing, when most of the people are used to buy linear economy and buying new stuff all the time. That's the way we've been educated for most of us in Western countries, at least. So the first thing that you have to think about is, do I have an opportunity to do something else and to embrace a trustworthy platform to consume circular economy? So that applies for tech, but also for fashion and also for other industries. But those are the biggest ones that contribute the most to climate change. So this is the first reflex. Like, is there a place where I'm safe not consuming a new product? And then you can find on your way back market, obviously, but you can find other platforms to consume fashion. Circular economy is getting scaled in most of the Western countries, and we are accelerating fast in order to provide the accessibility to most of the people there.
Do you get upset with Apple? We watch Apple. They come out here every 4 times a year and report their earnings, make big profits, but they don't seem to care about any of this.
Well, I hope they will at some point. I mean, we all live in the same planet. We have to get to net zero CO2 emission by 2050. Else the planet is warming up. And so if you do have kids, it doesn't matter if you work for a back market or for Apple, you want them to live longer on this planet and be able to, to live happy at some point. So getting to net zero is not an option. It's something that we need to do as a species if we want to live happily and to survive. So I think short-term, Apple is happy with these financial results because it's growing, the stock is going right, but ultimately, sustainability is not an option anymore, and so we're trying to demonstrate that with back market, and we are growing at high double digits everywhere now. So I think at some point, a circular economy will be a topic that's going to be on top of the pile for Apple and for other manufacturers. The sooner the better, obviously, but we're trying to grow as much as possible to get their attention in order to have them switch, basically, because they will go anywhere the customer will go.
If we were to see a major shift in the consumer spending patterns, how would and especially leading into a telegraphed yet, according to some economists, perhaps unpunctual recession, how might that actually support the circular economy even more? Where have you seen the propensity for consumers to lean into buying refurbished goods in those instances where they are saying, you know what, I'm being more scrutinous about my discretionary spending?
Yeah, well, so that's the main driver, to be honest. I mean, people are thinking about sustainability. They like to do the things in a good way, but what's driving the number one driver when it comes to purchase is purchasing power, is how much I'm going to save by purchasing a refurbished product rather than a new one. And the higher the gap is between new and refurbished, the most interesting the refurbished option gets to people. So the more inflation and price point of a new product is going up, along with the increase of raw materials. This is just the way it's been for the past decade, right? So the most it gets people interest to consider alternative. So the price difference is the main driver that is actually deviating the most of the people from not buying new anymore to solutions like back market or others who are actually offering circular economy. That's number one.
How large a problem are the large number of batteries going in electric vehicles? Those only seem to be coming hot and heavy as we look out over the next decade. Do you have a solution for that? And how concerned are you about the risk to our planet from them?
So I think switching the automobile and the car industry to a more electric industry is a good thing for the planet because it consumes and it emits less CO2 emission in the end to manufacture and to use them, less fossil energies basically to use the vehicles. So that's a good thing. Now we have to keep investing more and more in the innovation to recycle properly those batteries because it's lithium batteries. And I'm actually very optimistic on that front because we're seeing a lot of industry getting better and better in recycling those batteries. And in Europe and in the US, and now there is the Inflation Reduction Act in the US that is going to boost that big time over the next few years. Just remember, it's $370 billion that are going to be injected there. So I'm quite optimistic that we'll find the way to reuse them appropriately and get very low CO2 emission out of those.
All right. One of the more sustainable unicorn companies that is out there, Back Market co-founder and CEO Thibaut de la Ruse. Thank you so much for joining us here today, and a pleasure to see you again.
Thank you so much.
Absolutely.
Bye.
Well, let's end our Friday here with some key things that are coming up in this in this week ahead and ahead of the weekend. The final installment of our Ultimate Tax Guide that airs 11:40 a.m. In the final chapter, we're talking about everything you need to know to get in shape for the next year, financial shape. Inez Ferre is going to be joined by H&R Block's Chief Tax Officer for that conversation.
Way to drop the mic on that series. Plus, more on the bank earnings, this time focused on deposits. How much money went from regionals to big banks, and how much did it offset ongoing deposit outflows? We have those answers for you in just a few moments.
And later on, Big Pharma fights back. We'll break down how the industry is fighting to sway the impact of the Texas abortion pill ruling. Our 3 to 5 show is going to hear from both sides for an important and timely discussion. We've got all that and much more. Inez Ferre has you for the next hour of trading. See ya.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I mean, S for A. Here's what I'm watching. So far, so good. Big banks come out of the gates strong, with JPMorgan smashing expectations with record first quarter revenue. Attention still on the regionals. PNC's numbers putting some fears to rest there. JPMorgan CEO Jamie Dimon says everyone should take a deep breath and adjust on the fly. Should investors second guessing the Fed heed that call? We'll ask our strategists if calls for rate cuts are way off base. And finding a port in that storm, gold shining brighter than ever on ramped up bets. The Federal Reserve might just pause its tightening cycle on recent softer than expected data. We see if the trade has legs this hour. But first, let's take a look at where we're at with the major averages. We are seeing all three major averages that are lower. The Dow heading lower, down about 0.5%. Boeing weighing on the Dow there. The S&P 500 down 0.3%, and the Nasdaq is down about 0.5% right now. Taking a look at where we're at with U.S. Treasuries, we are seeing yields that are slightly higher. We're looking at the 10-year yield up at 3.51%, the 5-year 3.6%, the 30-year yield at 3.73%. And bank earnings still rolling in as the industry sees its first earnings report following the collapse of some regional banks, with bigger banks seeing capital moving in from regional banks. Here's Yahoo Finance's Rochelle Akufo with the latest. Rochelle.
Hey, Inez. Well, it looks like resilience despite the turmoil. Four of the biggest U.S. banks who shored up First Republic Bank with that $30 billion infusion amid the banking crisis reported earnings today. Setting the bar high, JPMorgan, the biggest bank with a strong top and bottom line beat. Interest income up 49%. Now, the bank boosted its net interest income forecast for the full year thanks to rising interest rates, which did lift the stock. But looking at what we saw with loans and deposits, total loans flat, but deposits up 1.6% this quarter by $37 billion from December to $2.38 trillion. Now, that is, though, still down 7% from a year ago. We saw depositors really looking for some of these safer havens in bigger banks here, seeing those outflows, but also seeing them chase high yields in money market funds as well. But, of course, the depositor picture this quarter has a lot of nuance, especially given how quickly the picture changed when SVB collapsed in early March and as the bank laid out.
The deposits just came in. So by definition, these are somewhat flighty deposits because they just came into us. So it's prudent and appropriate for us to assume that they won't be particularly stable. Number three, there's a natural amount of internal migration of deposits to money funds. So you have to overlay that, and that's embedded in our assumptions. And number four, it's a competitive market. And, it's entirely possible that people temporarily come to us and then over time decide to go elsewhere.
There's no pricing power that the bigger banks have. Because if you look at the pricing, and we look at pricing sheets all the time, every bank is in a slightly different position, and every bank is competing in 3 months, 6 months, 9 months savings rates. And then you have the online banks, you got treasury bills, you got money market funds. So there's no pricing power for the bank, but obviously we all have different franchises, and we're all in a slightly different position.
So JPMorgan, they're setting the tone to really keep aware of when you're considering some of these banking earnings coming out. Also taking a look at Wells Fargo, also seeing a top and bottom line beat and benefiting from that net interest income theme as well. That was up 45% to $13.3 billion. But they did leave full year guidance for both net interest income and non-interest expenses unchanged. Their deposits, though, fell 2% to $1.36 trillion. Also taking a look at Citigroup, their total loans down slightly for the group, deposits unchanged at $1.3 trillion, as you can see there, though, with a beat on revenue and adjusted earnings per share. And also taking a look at PNC, and as mentioned there, a little bit of relief here representing for the regional banks, although keep in mind PNC, one of the larger regional banks, their deposits up slightly, 0.3% to $436.2 billion. Their interest income down 3% to $3.6 billion. Obviously worth noting that being that PNC is one of the large regional banks, not necessarily representing some of the tinier ones, which did see a lot of inflows going into these bigger institutions. And of course, keeping in mind a lot of these bigger banks shoring up for what they could see in terms of ongoing repercussions from the banking crisis. And that's on top of being in January, these big banks already setting billions of dollars aside as they were already bracing for a recession and continue to shore up those banks as well. Inez?
Rochelle Akufo, thanks so much. And we continue on with financials. What's taking a look right now at if you're seeing a good buying opportunity in the banking earnings in the recent banking gloom? Well, you may not be the only one. Our next guest says to focus on names that are well positioned in the current volatile backdrop. David Chiaverini, Wedbush Securities Managing Director, Equity Research, joins us now. David, we'll get to which banks you see as better positioned than others. I know that you cover some of the regionals, but first I want to get your biggest takeaways from what the results we've been seeing so far this morning.
Yeah, I'd say the big takeaway is, interestingly, even though JPMorgan deposits were up $37 billion, the other big banks didn't see as big of inflows as one would expect, because the mid-sized banks we saw from the H8 data saw $200 billion of outflows. So it goes to show that more of this money is going to money market funds as opposed to the money center banks. So it doesn't necessarily bode well for the mid-cap banks that have yet to report.
And I know that you cover some of the regionals, and you have some names that you say that investors should focus on when it comes to this volatile backdrop. So quickly, what are some of the ones that you see and outperform?
Yeah, the ones I like here are New York Community Bank, Regions Financial, Fifth Third Bank Corp, and M&T Bank. And the reason for these four is that they have higher levels of insured deposits. And given this volatile backdrop, it seems as if depositors really like the safety of that insurance backing from the FDIC. So these are very well-positioned banks in this environment.
And Citi CFO Mark Mason this morning said that Citi has tightened credit underwriting in consumer loans. Do you see credit tightening when it comes to underwriting in the regionals as well as, could we see what we see in the bigger banks?
Absolutely. We've been seeing it for the past few quarters, looking at the senior loan officer surveys that come out quarterly. The next installment of that is coming out in early May. And we do fully expect continued tightening across the board, especially seeing these deposit outflows by necessity means that balance sheets are shrinking for the banks, and they are likely to tighten standards as a result of that. So we do expect continued underwriting standards to tighten, and credit availability to come down in ensuing quarters.
David, commercial real estate has been also in focus, and I know that the regionals also tend to lend in this space. What are you seeing there? Does this concern you?
Yeah, so right now, credit quality is excellent for commercial real estate loans, so not an issue at the current moment. But looking forward, we are expecting some weakness on the commercial real estate front. Non-performing assets are likely to go up, and while that certainly won't be a good look for the banks, the loan-to-value ratios, and this is very important, the loan-to-value ratios for commercial real estate across our regional bank coverage is around 55%. So that gives tremendous cushion to ward off realizing losses related to these loans. So again, non-performing assets likely to go up over the next 12, 18 months, but we're not expecting losses to actually come through because of these low LTVs.
And I know that on your list, you also cover First Republic, and we'll be hearing from First Republic later in April. I'm curious if you see a sort of bifurcation between the bigger banks and the regionals, that some of the ones that have suffered more than others when it comes to what's been going on in this banking turmoil, this recent banking turmoil.
Yeah, First Republic is a unique issue in that they had a high level of uninsured deposits combined with the fair value marks on their loan portfolio actually would take their tangible equity deep into negative territory. So that's what's made it difficult for the investment community to rally behind First Republic with a recapitalization, and also prevents the company from doing a voluntary sale of the company. So I am expecting deposits to be under pressure for First Republic. Now, I would say the silver lining for First Republic is that the Fed, the Treasury, they're providing tremendous liquidity to banks like First Republic. So First Republic can pledge loans and securities at par to the Fed, and they can pretty much handle any deposit redemption requests that are coming through because of that increased liquidity. So even though the backdrop isn't great for First Republic, we're not expecting receivership to come through anytime soon because they are able to meet these deposit redemption requests given all of the liquidity.
And David, are you watching anything in the M&A space? Are there any top takeover plays that you see on the horizon?
Yeah, there are a number of banks that I would say that are trading, at the low end of price to tangible book value multiples. And those ones that are probably, seeing more stress are more likely to see a potential takeout in this type of environment. We're not going to see many many big banks on the prowl from an M&A standpoint, but in a distressed situation, I could absolutely see some banks being sold, similar to what we saw with SVB and their bargain purchase. When they were sold in an FDIC-assisted deal. Signature Bank, same situation when they sold certain assets and deposits to New York Community Bank through an FDIC-assisted deal. So those distressed sales I can absolutely see occurring, especially for some banks that might be in a liquidity bind and potentially be searching for some capital here.
David Chiaverini, Wedbush Securities Managing Director, Equity Research. Thanks so much for joining us. And turning now to our trending ticker, Boeing pausing deliveries of its 737 MAX jet due to parts production problems. This is in addition to existing delivery problems with a decline in February due to lingering supply chain issues and a delivery pause on the Dreamliner. Boeing shares are down more than 5.5%, dragging on the Dow. And coming up, the disconnect continues. Markets insist on fighting the Fed, aided by weaker data in recent weeks. But is there really any chance of the Fed cutting rates before the year is up? We'll ask that question next. U.S. retail sales out this morning, decreasing by 1% in March, double the estimated decline by economists. As we roll into earnings season and the latest economic data, our next guest says flexibility will be paramount to navigate volatility. Joining us now to break down how to handle investing in an uncertain market is John Porter, CIO and Head of Equity at Newton Investment Management. John, thanks so much for joining us. Do you think the market is expecting a rate cut later this year, and is that premature?
I think the answer is yes and yes to both those questions. They're absolutely anticipating a rate cut. I mean, we can see that in the Fed futures expectations, and I think we can see that in investor psychology and in how they're behaving in terms of the equities that they're gravitating towards. But I absolutely think that that's premature and it's highly unlikely. At least it's highly unlikely in any scenario that isn't a real challenge for risk assets. I think if you look at the Fed's situation with their focus on inflation, with the mandate to maintain, full employment, they're there on full employment, so there's no need to cut to support the labor market. And inflation, while it's coming down, remains far, far above their target. And I think that the Fed has said repeatedly, when you listen to the public statements, that they're going to be careful about not being too premature to reduce rates, that they're very worried about, putting this fire of inflation out once and for all. And so I think that they're going to err on the side of conservatism of cutting, which makes any scenario of cutting anytime in 2023 highly unlikely, in my opinion.
And where do you see the markets going if we have seen this recent banking stress? We saw this retail data today. We've seen the data basically weakening over the last couple of weeks. And do you see a recession on the horizon? And where does the market go from here?
Yeah, I think you have to anticipate a recession as a likely scenario. I don't think anything of real severe in consequence in terms of recession is likely, but at least a modest slowdown, a modest downturn in economic growth should be expected as the most likely scenario. But as you said in the introduction, I think you have to stay flexible. I think there's so many cross currents in this economy right now, so many things that could go right and many more things, in my opinion, that could go wrong. I think you need to stay flexible, but I think that the likelihood of at least a slowdown is paramount. But timing's everything in investing. If you look at the here and now, and you heard it in some of the bank earnings today, the current state of the economy is very solid. The consumer's strong in spending. The behavior of corporations, while it's slowing in terms of hiring and CapEx, they're continuing to spend. But that's right now. Investing is an anticipatory game, looking ahead, discounting what might happen. And I see a lot of headwinds emerging over the next, say, 3 to 6 months.
So how do you position your portfolio?
Yeah, that's a critical question. I think it really comes down to your time horizon and how flexible you can be. What I've been trying to do in my portfolio as I manage growth strategies for Newton is I've tried to maintain a core position in the businesses I believe in over the next 2-3 years with that long-term focus, which is the preponderance of our investment focus, but remain sort of, keep a liquid part of the portfolio, stay flexible, and take advantage of stocks that have run very rapidly in trim positions, and take advantage of stocks where there's been sell-offs. Again, this is a cliche in investing, but I think right now, you need to be taking advantage of where there's weakness and skepticism and adding a little bit to risk assets. But where there's a flurry of excitement, I think you also need to take that as an opportunity to reduce risk assets. If you look, for example, at the year-to-date trend so far, it's been a great market overall. It's been very mega cap driven. It's been very tech driven. It's been an exciting 3 or 4 months, but I think the risk reward of some of those areas of the market that have been leadership so far are very challenging right now, and you need to be adjusting those tactical positions where you can.
So would you be getting rid of tech and mega cap? What areas would you focus on?
Any higher beta areas are something that I'm worried about for when I look out over the next 3 to 6 months. When you look at the headwinds of the economy, the consequences of the extreme tightening we've seen from the Fed over the last year is far from fully impacting the market. I think there's on the margin signs of slowdown in the economy. When you see that the job openings number has dropped by 2 to 3 million so far year to date, that's an indication that corporations are starting to be more conservative. When you look at CFO surveys, they're starting to get more conservative. So I think that higher beta, more risky assets in general are a source of funds right now. One other opportunity or one other issue I would point out that I'm surprised at the lack of conversation is just the conversation around the debt ceiling. That's something that was on the front burner of conversations a couple of months ago. The bank stress, I think, has overwhelmed that, understandably. But the debt ceiling debate is far from behind us. I think it poses an awful lot of risk tactically to equity markets right now.
And John, do you recommend that investors hold on to cash right now? Or at least some portion?
Yes, where possible, yes. In my portfolios, look, I manage long-only strategies, and my clients expect me to be largely fully invested, and I am. But on the margin, I have 4, 5, 6% cash in portfolios that I would normally have 1 or 2% cash. So I think where you can, I think having a little bit of flexibility to prepare for what's I think is going to be a pretty volatile market. I don't think this is a trending market. We haven't been in a trending market for more than a year. We've been in this relatively narrow trading range. If you look at the S&P 500, it's sort of been between 35, 3,600, 42, 4,300. That's probably the environment we're in for the foreseeable future. So having a little bit of cash to take advantage of those downturns opportunistically, I think is never a bad idea.
John Porter, CIO and head of equity at Newton Investment Management. Thanks so much for joining us. And coming up, a big beat from America's biggest bank by assets. JPMorgan smashing expectations, but are investors comfortable on chances of dividends and buybacks in the quarters to come? After the call is next. It's one thing to look at the top lines when the big bank results hit. JPMorgan coming out of the gate strong with a huge first quarter revenue beat and also a big prediction for future net interest income. But the earnings call had a slightly more downbeat tone. CEO Jamie Dimon with those weather-related analogies again. Yahoo Finance's Brad Smith was listening in. Brad, storm clouds?
Yes, storm clouds from meteorologist Dimon, of course.
Yes.
Well, lots to digest on the call. JPMorgan CEO Jamie Dimon had this to say on recent banking sector turmoil.
We're hoping that everyone just takes a deep breath and looks at what happened and the breadth and depth of regulations already in place. You know, obviously, when something happens like this, you should adjust, think about it. So I think down the road, there may be some limitations on held to maturity, maybe more TLAC for certain type size banks and, more scrutiny on interest rate exposure, stuff like that. But it doesn't have to be a revamp of the whole system.
And so Diamond kind of mirroring Aaron Rodgers from a few years back. RELAX, relax, everyone. However, let's also remember that Diamond also had some thoughts on the wider economic landscape on the call and the ripple effect of the financial system stress. Take a listen.
Yeah, I wouldn't use the word credit crunch if I were you. Obviously, there's going to be a little bit of tightening. And most of that will be around certain real estate things. You've heard it from, real estate investors already. So, I just look at that as a kind of a thumb on the scale. It just makes the financial conditions be a little bit tighter. It increases the odds of a recession. That's what that is. It's not like a credit crunch.
So there's a great deal of tenor that we get and tone from Jamie Dimon and executives at the bank that takes place on the call that doesn't necessarily come through in the words and the characters that you see on the earnings results itself once it's published. And that came through from a lot of big banks this morning. But even as you're thinking about some of the categories that perform best for them, consumer and community banking, that consumer spending remained healthy, and with combined debit and credit card sales up 10%, card loans up 21%, and how they talked about the U.S. economy, saying that the U.S. economy continues to be on generally healthy footings and consumers still spending and have strong balance sheets. And it's an important reminder that you could still be generally healthy, but perhaps have a sinus infection. So at the end of the day, it's where the consumer continues to engage with the bank, and the bank decides to tighten that relationship, perhaps, given the broader economic environment that the financial system finds itself in as well here. And so even as we're looking at the reaction here, pre-market, the shares were higher. You can tell that there had been a little bit more of a moderation, or at least a drift higher in the share price reaction as the call went forward. So amazingly critical to track what that tick by tick is doing, even on every single word that comes through from the bank executives. And over the course of the earnings season, it's also an important time for them to get the communication right and perhaps do a little under-promising, but over-delivering long-term as well here. And that's where some of that sandbagging strategy comes into play here. But net-net, for what JPMorgan did report, the shares reacted on that originally and initially. However, even as that was continued to be communicated over the course of the call, you saw that stabilize to the upside for JPMorgan, holding on to gains by about 7.4%. So my overall vibe check here, you know what? I'm going to give this a good one. Normally, I would say, you know what, it was about 3 out of 5 because we know what they're doing here. We know what the economic environment is. And I wouldn't say that they're trying to mislead, but I would say that they are trying to play their book, or at least play some of the hits for the investors here. That is a net good thing if you are on the JPMorgan side, or at least looking at kicking the tires on shares of JPM. It's important to remember where they sit within this broader banking system as well. The largest bank by market cap here in the U.S., of course, is in a far different position than some of the regional banks that we're going to hear about and hear from later on in this earnings season. So amazingly critical to do some command Fs on everything from deposits to loans and those net interest margins as well here. But for JPM and the communicatory tone from Jamie Dimon, the CEO of the big bank, they did pretty good on this earnings call. Inez?
Wow, one coming from you. You're a tough grader, so that's very good. Thanks.
Yeah, no scale here.
No scale. Brad. Coming up, gold shining brighter than ever on ramped up bets. The Federal Reserve might just pause its tightening cycle on that softer data. We see if the trade has legs next. Gold seeing a slight pullback after logging its second highest settlement level ever on Thursday. However, the precious metal remains on track for a 7th straight week rise. Here with more on where gold can go is Mike McClone, Bloomberg Intelligence Senior Macro Strategist. Mike, gold sitting above 2,000 an ounce. Is 2,000 the new support? And is it off to the races from here?
Yes and yes. Thanks for the easy question. I think it is. Pulling back a little today, but I think it's inevitable that gold gets above this $2,000 an ounce level and never looks back. And the key catalyst is the stock market potentially rolling over. And here's a big difference with gold compared to the stock market. I look at gold versus the S&P 500. It's very low on a 120-month basis. A 10-year basis is basically unchanged. The stock market total returns around 300% or so. Those are starting to reverse. And the big difference, the last time we did this was really around the start of the new millennium, was the Federal Reserve was well into an easing cycle. So I see this as just the catalyst for gold to take off. It's one of the few commodities I'm really bullish on because everything's starting to tilt downward towards deflationary trends.
Yeah, and we definitely have seen investors pouring into gold. Talk to us about what happens if the Fed doesn't pivot this year. I mean, what will happen to gold in that scenario?
Markets will make them. I think that's the stage we are right now. The Fed will pivot when the market makes them, and the number one thing to make them pivot is probably the stock market going down, the S&P 500 dropping at a higher velocity. It's been hovering around this 4,000 level, up or down 200 points from that. And I think it's just inevitable at some point it tilts back down because the Fed's not going to ease, it looks like, until it doesn't. I mean, the jaw opening from the Fed governors is quite serious. They keep talking about higher rates, despite the data we've seen all this week. They're starting to get that trend of misses, misses on PPI, misses on retail sales. It's just, to me, part of what happens in a recession. I think that's the stage we're at right now. The markets are getting it. 2-year-note yields, 10-year notes are getting it, but the Fed is still being vigilant against inflation, which is collapsing. You look at PPI, I see PPI in a year-over-year basis heading towards negative by the time we get to July. And that's just what happens normally when commodities collapse.
And you have an interesting note about the relationship between crude oil and gold. So what do you see, because most investors maybe aren't thinking that way, what do you see between that relationship and where gold can go?
The crude oil is an enduring bear market that had a bounce last year and tilting back towards that bear market aggressively. On a 12-month basis, it's down about 20%. $80 a barrel in this year's range has been between 65 and 85. And still, it's the upper end of range. I think it's going to go lower. And follow natural gas. Natural gas has dropped 80% from last year's peak. It's the number one measure of heat, electricity, and fertilizer in this country. And it's at this cost of production, a price that first started trading in 1990. I think crude oil is going to do that and go towards 40. So basically, deflation in fossil fuels is encouraging inflation in gold. And I think that's just starting to kick in and accelerate. You see the end of the quarter, end of 1Q close in gold was the highest ever. It's just hovering around that $2,000 level. And the key question I ask is what stops this? The Fed is still tightening. Typically, when you have commodities collapsing at this velocity in the past, the Fed has already been easing, and they're still vigilant against that. So I see what we're doing is heading towards a severe deflationary recession, as indicated by commodities, by the Fed still tightening, the curve's significantly inverted, and now we have a pretty serious credit crisis going on with just pulling back at deposits from the major banks. That means it's just starting to get started. And the key thing I'll end with is that we were just looking at annualized industrial demand for natural gas in this country. It's the lowest in 6 years now, and that's an annualized basis, so it's not seasonal.
How do you think investors should buy gold? I mean, for people that are just looking at this gold rally, this recent gold rally, and thinking, man, I want to get in on this. I mean, what is the best way? Is it through ETFs? Should they be buying physical gold? What do you say?
Well, that's the thing that ETFs made it so much easier for people like me who used to, I was kind of afraid to buy physical gold before ETFs, so you buy equities. ETFs are such an easy way to do it. It's quite clear. But I think one thing that's going to be coincident with this gold rally is the rally we're having in U.S. long bonds and declining yields. So ETFs are just an easy way to express those views and investments.
And the miners?
Well, it's the history of miners. Miners, you have to be more selective. You can get those many X's of returns, but you have to be selective. The overall miners, like the GDX index, has a history of underperforming gold over time. The key reason for that is you just can't create more gold cost effectively like you can crude oil and a lot of other commodities. So overall, that physical ETFs that track gold have a history of outperforming indices like the GDX index, which is just an index of miners.
Mike McClone, Bloomberg Intelligence Senior Macro Strategist, thanks so much for talking to us about gold today. And a 21-year-old member of the National Guard was charged this morning in connection with the leak of highly classified government documents online. With more on what this security breach means for the U.S. and how it happened, I'm joined by Yahoo Finance's own Rick Newman. Rick.
Hey, Inez. Right, so we have a suspect here. I guess there's some good news in that this 21-year-old airman from Massachusetts, Jack Teixeira is his name. I guess there's good news in the fact that he doesn't seem to be doing this on behalf of some foreign government, selling this material or something like that, or just doing it out of sympathies with Russia or some other foe of the United States. But on the other hand, what the heck? I mean, this guy apparently was not even working on issues related to Ukraine, and he was able to go into an intelligence system that sort of sounds like it's a Wikipedia at the top secret level inside the intelligence community, and just pull off pages and print them out and take them home. And he was basically posting these in a little chat room for some gamer buddies who were mostly teenagers. And he was just trying to show off and demonstrate to them how much he knows about the real world by virtue of being able to download all this classified intelligence, including some of it at the top secret level. So, I mean, there are massive questions here about how the intelligence system can allow this to happen. And I think as this process unfolds, we're probably going to see some reforms meant to make sure this doesn't happen again.
A lot of questions to be answered for sure. Rick Newman, thanks so much. And retail sales in March on the decline for the second straight month, hinting that consumers are feeling more cautious with spending. If you are an indecisive shopper, listen up. The era of free returns may be behind us. Amazon announcing customers will now face a $1 fee for each return made at UPS. With more on what this could mean for the retail landscape, Yahoo Finance's Ali Garfinkel. Ali, $1 to return stuff.
Yeah, Inez. So this is the thing about Amazon. The company has built its e-commerce business on making returns and shopping fast, easy, cheap, and foolproof, really. But that reputation is about to really be tested here. I spoke to 5 retail experts to try to get a sense of what this means for Amazon and what this might mean for how consumers will respond to Amazon from here on out and the industry at large. And I'd say there were 3 key takeaways. I'd say the first is that there is one thing they all absolutely agreed on, and it's that this was inevitable. It was truly really interesting to hear the phrase tremendous burden over and over again, because that's what returns are for retailers. And, you can actually just look at some of the numbers from the National Retail Federation to really bolster that case, right? For instance, customers sent back around 17% of the total merchandise they purchased in 2022. That amounts to about 816 billion. And then for every 1 billion sales, the average retailer incurs 165 million in merchandise returns. It's important to say that this is actually just the beginning. Remember, there are logistical costs, supply chain problems like, for instance, the product you return may not go back to the warehouse it came from. There are also issues reselling a lot of those returned products. For instance, I don't know about you, but I personally don't necessarily want something that's been used, tried on, and then sent back to me. The second is that there is a certain type of customer Amazon is targeting here. There's this idea, and there's actually some data suggests that there's a world of customers who like to try and buy, sell back. And it's really challenging for a company to make money with customers who engage that way. So in the end, it will still be possible to return things to Amazon for free. But if you're a chronic returner, that's going to get a lot harder. You'll have to, if you want to return something to Amazon for free, you're going to have to, for instance, select a specific reason, like the product being defective. Or if you're returning to a very, very small package to an Amazon locker nearby, you might actually be able to do that return for free as well. But it's going to get a lot harder to do those free returns. And lastly, this is going to give online retailers a chance to start really operating differently. Now, what does that actually mean? Well, many retailers over the years have very quietly, trying to keep it under wraps, been keeping return fees on the books. But because Amazon has been the no return fee king for so long, it has definitely put pressure on the industry to keep those under wraps. That is all about to be over. One expert I was speaking to said that other companies may start raising prices on returns and using Amazon's move as a shield. I'd actually like to read you a quote from Professor Mark Cohen at Columbia University. He had some pretty fiery words about this. He really doesn't like the economics of free returns. I think the industry should be kissing the ground Amazon walks on for returning the sector to some semblance of economic sanity. To wrap this, I want to go back to the retail report you mentioned at the top. Second straight month of slowing retail sales. And I think we're seeing it across the board, right? Electronics, general merchandise. And I think that tightening spending is really putting the pressure on e-commerce, not only to grow, but to get the economics right, Inez.
So shoppers are going to have to think twice before they order. No more free returns. Allie, thanks so much for joining us. And coming up, did a rush to get your taxes done in the last few days inspire you to get ahead of the curve next time? Yahoo Finance's ultimate tax guide looks to the year ahead next.
Small business owners have faced numerous challenges in the past couple of years, but luckily there are some tax credits and deductions that would do to help. Here are our top 3. The first one is an Employee Retention Credit, commonly known as an ERC. It's a pandemic-era credit established to help employers return their workers during this era, and each qualified employees can claim up to $26,000. Although this credit was a COVID-19 relief benefit, business owners have 3 years from their original tax return to go back and retroactively claim this credit. The next business credit on our radar is the bonus depreciation. In 2022, small business owners can claim 100% bonus depreciation. What this means is if you have a qualified asset, instead of waiting for a period of time to expense them, you can write off the entire thing in just 1 year and without having to wait. The bonus depreciation rule does start to phase out next year, so make sure you take advantage of it before then. The last one is the 100% business meal expense. In 2022, business owners can deduct any qualified business-related costs relating to food and beverages bought in a restaurant. The IRS also allows any tax and tips included in the deduction. However, do be aware that these meals should not be lavish or extravagant.
Well, did you leave everything to the last minute and now find yourself panicking over taxes? It doesn't have to be this way. We're showing you how with Yahoo Finance's ultimate tax guide. Joining us now on the phone with tips to keep next year's tax day stress-free is Kathy Pickering, H&R Block Chief Tax Officer. Kathy, thanks for joining us. So what are the lessons that we should learn from this year for next year?
Well, good. Yeah, it's so good to be with you today, and thank you for having me. We really want to encourage everybody to definitely do your taxes. We're now back to a more normal season, a more normal rhythm after a couple of years of COVID with extensions. And so here, what people need to know is that April 18th is tax day. We've just got a few more days left to get filings done. And what's so interesting is that nearly 1 in 3 Americans wait until the last minute. And based on a recent survey that we've conducted, 22% of Gen Zers wait until the very last second to file. We also, go ahead.
Yeah, no, go ahead.
We conducted a survey recently that just asked, what do people think will happen if they don't file? And 72% or 70% said that they think they could go to jail if they don't file by the deadline. Now, the good news is that really is the case, but it's still astounding to see how many people wait until the very last minute to file.
Yeah, especially because 75% of taxpayers receive a refund, so you don't want to wait to get that to get that as well. Tell us, what are some of the steps that you can take to get a jump start on 2024?
So getting ready for 2024, right now, after you've filed your taxes, is the perfect time to put together your checklist of what are the documents that you're going to need for next year. It's also a perfect time to do a paycheck checkup. So if you didn't get the tax refund that you were expecting, or if you ended up owing money, this is a perfect time to look at what your withholdings are and make sure that you're having the right amount of taxes withheld from your paycheck, or that you're making appropriate estimated payments throughout the year to avoid that end of year sticker shock, so to speak.
And there's some moves also that for you to be able to lower your tax bill. Talk to us about electric car initiatives, planning for more energy efficient homes. How does this help one with their tax bill?
So this is really exciting. In the Inflation Reduction Act, there were new tax credits put in for electric cars. And there's also energy efficiency home improvement credits. So things like putting in energy efficient windows or doors or other kinds of improvements that you would make to improve the energy efficiency. So these are things that as you're planning now in 2023 to either make purchases or do these improvements, you'll want to understand what the rules are, how much credit you can get, because there's certain documentation you're either going to need to retain or pass along to your tax return. But you definitely want to take advantage of those as you're going through the year.
And do you recommend keeping sort of receipts for things, throughout the year? Because it's often the case that, come April, you're like going back through the whole last year. So how can people sort of get ahead of that?
We absolutely recommend keeping your receipts. But that said, H&R Block has a secure encrypted portal where people can upload their documents and store them throughout the year. So then you've got them all in one safe and secure place. There's so many electronic tools available now to enable people to organize their receipts, to organize their business records, that make it easier when it comes to filing season to make sure you've got everything you need all in one place.
Organization's the name of the game. Thanks so much, Kathy Pickering, H&R Block Chief Tax Officer. Thanks for joining us. And Americans cut their spending in March for the second straight month, a sign consumers are feeling the pinch in their wallet amid rising rates. And while the federal funds rate rapidly grew over the past year, so has credit card interest rates in the U.S. rising to roughly 20% in the first quarter of 2023. Here with some tips for credit card owners in the face of elevated rates is Yahoo Finance's Carrie Hannon. Carrie.
Yes, absolutely. We're at all-time highs for credit card rates, over 20% now, up from 16% a year ago. So consumers are really feeling the bite because the majority of cardholders carry debt month to month for at least a year. So this really adds up, and you need to take control of that because it's directly impacted by how the Federal Reserve, when they hike up their rates, it hits your credit card probably a month to 45 days after the rate hike goes in. Then it shows up in your credit card and the rate that you're charged by your issuer. They don't have to give you a special notice that they're going to bump that rate up because it's tied to the index. Your credit card's tied to the prime rate, which is about 3 percentage points above the Federal Reserve rate. And then they build in their profit margin of maybe 12%. So it's really important for consumers to understand what this impact has. If you carry a 5% balance and you're only paying your minimum balance, it's going to take you years, maybe 15 years to pay off that debt. So it's really important to take action now.
So what are some of the tips for those that are facing credit card debt amid these higher interest rates?
Yeah, the fastest way to do it is if you can qualify for a zero balance transfer credit card offer, and they're out there. You can transfer your balance, your high balance, over to a zero interest card, which is usually around 21 months. Now, you'll pay a small fee for that, 3 to 5% of your balance, but it is well worth it to give you that breathing room. You might also look to a personal consumer loan. Now, these aren't as easy to get as they once were, of course, but if you have an excellent credit rating of, say, 750 or above, you might be able to get a personal loan for 2 to 5 year duration of 7 to 8%. That's a big drop down, and again, helps you get control of that debt and start paying it down. The second thing I recommend people do is to automate. If you can automate your payments directly each month from your from your checking account, that helps you keep away from getting late, but getting behind and having extra fees, and also, paying more than the minimum. By all means, pay as much as you can towards that balance. The third thing you can do is actually try to negotiate with your credit card issuer. If you've been paying on time and you have a good credit score, it's possible they may lower it for you. Or if you're really in a pinch, there are nonprofit debt counselors, and the Justice Department, if you go to their website, they have a list of ones that they vetted that can help you negotiate directly with the issuer to lower that rate for you. You'll pay a fee for that as well, but it's really important that you take action. And if you have multiple cards, my recommendation is go to the card with the highest percentage rate and put as much towards that one as you can to get started.
Some solid suggestions there. Thank you, Yahoo Finance's Carrie Hannon. And coming up, keep it charged. A new poll suggests Uber might be keeping a close eye on your phone battery level to increase your fee. Is this just another conspiracy theory? We break it down next. Uber is in the spotlight as the company faces accusations from a Belgian newspaper that it can see riders' phone battery levels and changes rider fares based off of that information. Yahoo Finance's Praz Subramanian is here with all the details. Praz, and when I saw this, I just thought this is so wacky.
Yeah, I mean, it's an interesting story. Is it sort of Uber being back to being Uber again, right? Those bad days back in the past. But basically, like you said, they've been accused of looking at battery levels of their users when they're searching for trips, identical trips. So a Belgian newspaper, this is a small study a Belgian newspaper did. They had two identical phones charging the same trip, and the one with the the fewest, the lower battery got a 6% higher charge for the same trip, right? So that's the sort of the assertion from the paper. Now Uber denies this, and they said that, quote, Uber does not take into account the phone's battery level to calculate the price of a trip. But it's kind of interesting if they are, right? Because it's sort of a thing that they would possibly do because, clearly if you're low on battery, maybe you would be more inclined to take a trip if you need to go somewhere. In fact, Uber back in 2016 said they actually had data that showed that people were more likely to spend money on a price surge trip if they have low battery level. So it's there. It's sort of nefarious. Would they do it? Wouldn't surprise me back in the Travis Kalanick days, but now it seems a little bit beyond the pale.
So it's basically that it's like, oh, you're in more higher demand now. You want this more desperately, so we're going to charge you more.
Yeah, because you're saying my battery might die. I need a trip wherever I am. I'll pay more for it, right? That's the assertion.
And 2 phones that are been studied. Just 2.
They had 2 phones, one with I think 80% charge, one with something like 13% charge. We had this chat, the full screen up just now, and they both clicked on the same time for the same trip, identical trip, and the one with the lesser battery charge had a 6% higher fare.
Now, to be fair to Uber also, though, I mean, when you go, or at least, I don't know, when you go to book a trip, and I book some of them from my place to my mom's place, sometimes for my mom, and it's always slightly different. I mean, you're never really getting the exact same fare.
Yeah, I mean, because there's hundreds of people probably doing in New York City at a certain time where our office is, for instance, hundreds of people are charging or looking for trips, various parts of the city. It's always going to be dynamically changing. So they can say, hey, look, 6% is not that much of a difference, even though it's identical time, phones in the same area, it's taking into account all the drivers and the phones in the area. So that's why there's a slight discrepancy. But it is interesting that they do have data for it, and it wouldn't surprise me if there's a way to extract a bit more value, some profit out of the same trip. Why not do it?
Praz Subramanian, this is one of those talkers for sure. Let's do a final check of the market. Right now, we are seeing all major averages that are slightly lower. That's it for me. I'm Ines Ferre. Thanks for watching.